Good evening and welcome to this session of the virtual coaching classes organized by the Board of Studies of the Institute of Chartered Accountants. Good evening. In the last class, we began a new topic, the appointment and remuneration of managerial personnel, which is chapter 13 of the Companies Act. Right. So good. Nice to see some of you here, or rather Ms. Rashmi Kamath here on a Sunday evening. Good. So let's hope we'll have a good session. I did cover quite a lot of ground. I did go through the qualifications, more importantly, the disqualifications of a MD or a manager, etc., etc. Then we saw Schedule 5. I also gave you a broad schematic understanding of this very important document. The basic thing that you need to understand is if you appoint a person at the time of appointment, you see, the managing director or the whole-time director can be appointed for 5 years. Now, if you appoint him under Schedule 5, read with Section 197, then the advantage is you need not go to central government in case you don't have profits. Even in an year of loss, you can go through Part 2, Section 2, where there is no profit or inadequate profit. In case there is adequate profit, and you are still well within Schedule 5, except that you can go up to the percentages given in Section 197, where there is adequate profit. Where there is inadequate profit, that is, there is profit, but it is not sufficient to pay the salary that you have negotiated with the candidate. So your MD is expecting to be paid so much, but when you multiply it by 12, you get a number that is more than the profit. So how do you pay this guy? You calculate 5% of the profits and you get a number. That number is not sufficient to cover even his salary. How do you pay? So that is called inadequate profit. Okay. Or loss, of course. No profit. In those cases, if you are through Schedule 5, you have no problem. Otherwise, you'll have to go to the central government. You understand? Which means Part 1 is very important. Part 1 gives the conditions. We saw all that. I'm not going to go through it again. I just want you to understand the framework here. So, but suppose the guy does not satisfy some of these conditions. Okay. Then some of them are tough. For example, if he has been fined under, say, the FEMA for 5,000 rupees, he's out. If he has been fined, convicted, which is why later on, maybe myself or some other faculty will teach you another topic. It's called compounding of offenses. You will actually pay more than the fine. You will pay a compounding fee, which is 3 times or 4 times the fine. Or depends. Okay, on the various laws have different compounding rules. We will be teaching you Companies Act compounding rules in later. But you will understand the importance of it. Please link it with this. Suppose Mr. A is the managing director of a large listed company and there is a FEMA violation by that company. And of course, the CFO are all liable, but MD is also liable. Suppose the MD is, prosecuted and he is fined. Remember, even if he is fined for 5,000 rupees, forget imprisonment, even a fine of more than 1,000 rupees would mean he cannot be appointed under Schedule 5. So very serious problem. In case the company is not doing well in, say, 2 years' time, you'll have to go to the central government, etc. Which is why compounding. So when you go for compounding, what happens? You don't get convicted. The prosecution is dropped. Or if it has already gone to court, the court will close the matter and put state as acquitted. There will be no conviction. Please try to remember this and later on relate it when you come to compounding, because some of you will have a natural doubt. Sir, is it not better to pay the fine? Compounding is costlier. Why should I go through compounding? Because if you pay the fine, then you are convicted. Remember, maybe if I'm teaching you, I'll tell you in more detail how prosecution happens. You have to go to court and there you will be convicted. Okay, it's a conviction and you will pay a fine. Of course, you will pay the fine and you'll walk out, but your record is noted. You are convicted for an offense under FEMA, right? So that's one of the reasons why you might want to look at compounding closely when you come. Now, compounding is available under all laws. All these laws, which are seeing here, have a section on compounding. Luckily, they allow compounding. Companies Act also has, FEMA has compounding. Check it out. When somebody teaches you FEMA, they will teach you compounding also. Good. So, moving on. Where there is adequate profit, no problem. Company is having profit, section 1. This is the percentage, we already know that. Sitting fees. Now, so we have to pay, we can pay up to 11% of net profits computed in accordance with section 198. Course of the session, I would be going in depth into how to compute the profit under section 198. In the meantime, a quick review. I'm just doing a review here, a quick review. Try to see if you can get the answer. You could just put one of the choices on the query pad. You got A, B, C, D. This is an MCQ type. So all you need to do is put up a query. Later on, we'll come to 198 when I'll teach you in more detail as to what is deductible, what is not deductible, what is to be added, etc., etc. This is a quick, Yeah, if you have any answers, you can put it up on the query pad. I'll give you, say, 2 to 3 minutes to do this. And no, please note it's net profit after tax. Okay, since I don't seem to be getting that many answers, let me quickly go for, simple. The profit is 1 lakh. We already debited a provision for tax, can be added back because managerial remuneration is to be calculated before we provide for tax or before tax. So if tax is reduced, you have to add it back because remember, managerial remuneration as computed under the Companies Act is a charge against profit. It's a P&L item. It's not an appropriation item. It is not an appropriation of profit. No, it is a charge against profit. You reduce it from the profit to arrive at taxable profit, right? And so long as it is so long as it is paid to the managing director, technically it's allowable under the Companies Act, right? It's allowable under the, it's allowable under the Income Tax Act. But sometimes they insist that for listed companies and public companies, whether it is in accordance with the, limits, etc. Okay. Later on, we'll see what happens in case it takes more than the limits. Okay, so here it's a simple calculation, 5% of this. How about sitting fees? See, sitting fees are deductible. They are expenses to be deducted for arriving at profit for the purpose of determining managerial remuneration, right? Okay, so we've seen one more important aspect, which is, okay, is there a lag or something between your putting in the answer and me getting it? Check out. I'm going to give you one more, practical example for you to appreciate. So that thing. So this is the situation where the company has loss or inadequate profit. Means profit is not sufficient to pay salary. In which case, company can pay remuneration on an annual basis. They don't actually say salary. You see, you can either pay a salary or as, some kind of a percentage of profit basis or share, whatever. So long as, or as a commission, whatever. Okay. So long as the amount does not exceed 60 lakhs, for those companies having negative effective capital or less than 5 crores. Then you have 5 to 100, then 100 to 250, then 250 and above, 250 crores and above. So 60 lakhs, 84 lakhs. Okay. Actually, I don't see any pattern here, but you just have to remember it. Negative or less than 5. Sometimes there's a nice pattern emerging. Okay. And that if you remember the pattern, you can just simply do the math and get the answers. So, but there's no big pattern here, except that 60 is 5 times 12. 84 is 7 times 12. So, and 120 is 10 times 12. So, 5, 7, 10. And that will be again confusing you. So, rather, if you remember 60, 84, 120. And for other directors, you see, we use the word other directors. You remember we kept on repeating for the purpose of section 1, section 2, section 3 of schedule 5 part 2, the term other director shall mean a non-executive director or an independent director. See, there's a bit of a confusion here. Why should they say non-executive director or an independent director? Because basically an independent director is also a non-executive director. They want to make it abundantly clear that an independent director also is eligible for remuneration even in an year of loss, provided he has been appointed under Schedule 5. So going under Schedule 5, even an independent director can be paid up to 12 lakhs per annum. Each of them, suppose you got 15 independent directors, you can pay 15 or each of them a lakh, up to a lakh, means per month, up to 12 lakhs per annum. That's an upper limit. You can always pay less than this. Okay, this is the upper limit, or this is the limit provided, above which you cannot pay, right? So 12 lakhs, 17 lakhs, 24 lakhs. Okay. In case your effective capital is 250 crores and above, you have 120 lakhs plus 0.01% of the effective capital in excess of 300 crores. I'm sorry, 250 crores. We saw the example of 300 crores, where the effective capital is 300 crores. You pay him 1.20 lakhs plus on 250 crores. Let's see, I'm not very good at numbers, so I'll calculate it. On 50 crores, you will pay him 0.01. It's not much. Okay. But then you can pay that also to him, right? So, moving on. Some important highlights. Paid up capital includes preference also. Paid up capital includes, paid up share capital includes preference share capital also. Securities premium account included. Reserves and surplus, they do not use the word free reserve. Elsewhere, we might find the words free reserve being used. As I mentioned yesterday in the last class, 181C, they use the word free reserves. Many other cases, buyback of shares, they use the word free reserves. Many cases, bonus, free reserves. So, free reserves are those reserves which are available for declaration of dividend. But here they do not use the word free reserves. They use the words reserves and surplus, which means all reserves, unless specifically excluded, can be taken. Your capital redemption reserve can be taken. Your dividend equalization reserve can be taken. Your what is that 10 AAA? You have that SEZ reinvestment and reinvestment reserve, which has to be kept for 10 years. That also, okay, all reserves can be considered. So long as they're not specifically excluded, we'll see which one. There's one guy who is specifically excluded, which is revaluation reserve. If you see revaluation reserve in the balance sheet, it should not be touched. Other than that, everything can be taken. So what you will do, you will take all these guys, total them up, and ensure that you do not include these guys. You should not take share application money. You should not take revaluation reserve. You should not take working capital loans, overdrafts, etc. Any on-demand loan, which is not. Because you are entitled to take long-term loans and deposits repayable after 1 year. Long-term loans and deposits repayable after 1 year. Right? But working capital loans, no. OD, no. Because they are all working capital loans in India are called CC, cash credits. These are called on-demand facilities. As I mentioned the other day, on-demand means if the bank makes the demand, you have to pay. Maybe the loan agreement would give you some 2 months grace period to wind up, but you have to pay on demand. You can't, there is no fixed tenure or term, right? So, which is why you have to pick up. Similarly, you have investments. Now, investments are not merely excluded. Please understand, you total up the include items, then don't ensure that you don't take the excluded fellows. If you have investments on the asset side, you have to reduce it. Please understand. If you have investments on the asset side, you have to reduce it. Why? Because what we are actually calculating here is the capital employed in the business. The capital employed in the business. So more the capital, the more the decision making. See, with more and more money involved, the type of span of control of the MD is high. So the decisions he's going to take are more complex. That is all we are trying to find here. Now, here is a case where the company's money has been taken and invested in some other company. It has been invested. Now, where is the MD's decision here? Where is the MD's involvement? Okay. So it is invested elsewhere. Somebody else is managing that money. So therefore, we reduce investments for calculating effective capital. This is similar to the formula for return on capital employed. See, when you calculate capital employed for return on capital employed, ROCE, you will use almost a similar topic. Always remember, and in the exam, they might catch you out there. For an investment company, you should not exclude investments. Why? Because the whole goal of an investment company is to invest the funds and get a return. Therefore, the main decision making of the managing director is going to be in making investments. Therefore, investment should not be excluded for investment company alone, right? If it is other than investment company, so you be careful. Sometimes they might inform you that it is an investment company. You might miss it. So be careful is the point I'm making. Okay. Finally, if you see any accumulated losses, obviously the current year's loss would be there, right? The current year's loss would be there. You have to take that off. And unless you know your P&L account already has some credit, in which case no problem. But in case the company has been making consistent losses over the last 2 years, there is an accumulated loss or any preliminary expenses not yet written off, these two fellows will be appearing in the reserves and surplus, under reserves and surplus, negative items. Because today, in the balance sheet, in the Schedule 3 format, we do not have any, shall we say, miscellaneous expenditure and losses heading. In those days, in the old Schedule 6, you had a separate line item under assets called miscellaneous expenditure and losses, where we used to include these so-called fictitious assets. Now, the fictitious asset is still there, but you would not be able to show it under asset side. You will have to take it to the liability side under reserves and surplus, so it has a negative. You know that. I shouldn't presume to even teach you financial reporting, but then, having said that, that has to be reduced is the point. Good. Now, in an year of incorporation, you will have to take it as on the date of incorporation. In any other case, on the last date of the financial year, preceding the financial year in which the appointment of the managerial person is made. They actually do not use the word audited balance sheet here, because sometimes the MD's appointment may happen before the audit is completed. So all they are saying is take the figure as on the last date of the preceding financial year. Okay, quick illustration. You may want to do this if you want. I'm not getting any responses on query pad. Just assure me that somebody is out there listening and put in an answer to this, shall we say, problem. What is the maximum remuneration payable? Can you notice one thing? The company has made a loss. The P&L account has a negative balance. So you cannot apply section 197 directly. Luckily, this guy is appointed under Schedule 5. Mr. Nivas is appointed under Schedule 5. So what is the remuneration which we can pay him? Okay, Dara Shah has given a reply which says 10. Madam, I'm not very clear. What is 10? You're answering which question? The earlier one? No, I don't think so. So what is 10? And give me an answer for this. What is the amount you can pay? Actually, this cannot be asked as a multiple choice question. It is, see, that is where MCQs fail, because there are easily two options to this question, but at least tell me within the framework of Schedule 5, how much can be paid without going outside of Schedule 5. Beautiful, beautiful. Aniket Jain gives the right answer beautifully. So since he has given the right answer, I'm so sorry, yeah. Okay, that was a bit of a, yeah, beautifully said, Mr. Aniket, correctly said, I should say. So applying the rules, you have paid up equity share capital to be considered, right? Authorized, okay. No, I'm sure none of you got fooled by the authorized. Then debenture redemption reserve. This is something you might want to remember, because it's not specifically excluded from the definition of effective capital, included. Securities premium account or share premium account or whatever they call it, included. So that's 10 plus 10 plus 20, 40 minus the loss, 20. There is a revaluation reserve not to be considered, excluded. Okay. So you have an effective capital of 30. Friends, I have already put up an assignment in the portal. In your portal, I have put up an assignment. Anybody, if you have seen the assignment, can you put up a thumbs up? If you have not seen it, put a thumbs down. Ms. Dara Shah, have you seen the assignment? Just put a thumbs up there. Aniket Jain, just put a thumbs up there. Otherwise, put a thumbs down. And I'm still not clear what is the 10 Ms. Dara Shah was talking about. Can she clarify that? Okay. So as Aniket has rightly found out, the effective capital is 30 crore. And so 30 crore is 5 and, see, if you remember, negative to 5 crore, then 5 to 100. So this comes in 5 to 100 category when you can pay him 84 lakhs. Now, please remember, let me go there and show you. If a special resolution is passed, you can pay more than this. If the members are okay and they pass a special resolution, you can pay more than this. This is something you might want to remember while answering questions like this. Because, see, this could be included. See, for example, somebody could have reserved a 1 mark for a guy who wrote this or a lady who wrote this, the second line. If company passes special, that you are aware. Okay, suppose you didn't, you would be arithmetically correct, 84 lakhs. And you would say, for example, I would give 3 marks for this question. I would give you 1.5 out of 3. Okay, but I still have got 1 mark left, which you had written this, I would have given you 2.5. 2.5 or even 3 on 3. If your handwriting was good and you did it well, I would have given you 3. Remember this. Marks, friends, those of you who watch T20 and all that, you'll remember there's a run rate. There are so many overs and you have to take so many runs. So similarly in the CA exam also, there's a mark rate. You got 3 hours and you got marks per minute. I used to work by marks per minute. So as I'm answering questions, it's like how many? Okay, no problem. You entered it wrongly. And please see the assignment. It has a lot of interesting questions, which maybe we could discuss in a future class. Okay, if you people are all ready, I will discuss in a future class. Coming to the point, there is something called marks per minute. If you understand this, it's one small secret of getting high marks in CA. Many students don't know marks per minute. Secret. It's a secret. Many people don't know it, but they get high mark because they are fast by nature. But some of us, we are very conscious. For example, when I'm working on one question, I give myself so much time. Within that time, I have to get the maximum marks for that question. If I'm not getting it, okay, I'll see how many I've got. 3 out of 5, I'm assured 3. Move on, next question, because if I continue to write this question, I'm not going to get one more mark for that extra minute I'm spending here. Push, go to the next one, right? Go to the next one, right? Maybe if I have some 20 minutes time at the end, I can always come back here and polish it. But believe me, we know for sure how many marks we'll get once you write. So much so that some of us, when we walked out of the exam hall, we actually knew how much we could get. We would be a little conservative, but we would still be able to pinpoint a ballpark and say, hey, this is where I'm at. And we will be very realistic about it. Of course, I've got a lot of guys who come out and say, I'm going to get 60, I'm going to get 70. Mark, I'll take the question paper, and for each question, honestly, what did I write? What is the answer? How much I think I would have got? Finally, I will end up with a number which is say 50, 45, but then maybe it will be more, okay, or less. But around that only. 45 may become 42, or 56 may become 60 or 54, but it will be around that ballpark. Check it out. Next time when you're practicing, check out the time you're taking and the number of marks you're getting per minute. Like a run rate, you have a mark rate. Keep scoring, which is one of the reasons why somebody leaves 2 questions and comes out. He's going to be evaluated for, say, what about the balance marks? Suppose he wrote only for 80 marks. He's not going to get 100 on 100 for 80. He's going to get less than that. That's where the danger starts. So moving on, and as you rightly pointed out, here's one more question quickly. I've not got the answer for this. That's not a problem. You can compute it. So 15,48,000. All you need to understand is, okay, what I'll do is when I go to 198, I will revisit this problem again, because right now without 198, this may be a little vague. We'll revisit this problem when we go to 198. Maybe the answer is on 198 and the question is here. Chalo. Now we move on with the topic. In case of a managerial person or other director who is functioning in a professional capacity, please, I think we discussed this in the last class, right? So professional capacity means a chartered accountant, a company secretary, who is also a member of the board. Company secretary can be a director. CFO can be a director, except that they would never be an independent director. There will be always non-independent directors, employee directors. So now, please note, when these people are working in a professional capacity, they would not be willing to accept whatever you fix, etc. So remuneration as per item A discussed above may be paid if such managerial person or other director is not. See, one more thing, no? For a CFO with 15 years experience CFO, okay, the company is having 250, 100 crore and above. This is a normal salary, not around 96 lakhs to 1.2 is a normal. There's nothing. This is for a CFO with say 15 years experience, with good 15 years solid experience. This is not a big deal. This is not a big deal at all. Okay, so you can pay. Okay, provided they should not be having any interest, whether directly or indirectly, or through any other statutory structures in the capital. Statutory structure means holding company, subsidiary company, all sorts of divided. Idea is they should not have any interest directly or indirectly or through any statutory structures in the capital of the company, its holding company, or any of its subsidiaries at any time during the last 2 years before or on or after the date of appointment. 2 years before or on or after the date of appointment. So at the time of appointment, no. Okay. After also they should not. 2 years before you have to see, did they have any interest, directly or indirectly? Means they could be owning shares, or somebody who's related to them may be owning shares, either in the company or its holding company or any of its subsidiaries. Then, and only then can you pay a managerial person who is functioning in a professional capacity. Okay, such a person, should possess graduate level qualification with expertise and specialized knowledge in the field in which the company operates. See, the idea is simple. They want to prevent owner managers from coming through this section as professional directors. So therefore, they are saying, if you're saying he's in a professional capacity, then then he should also satisfy the non-interest criteria and also possess graduate level qualification, right? See, in my humble view, this whole provision has no meaning for me because, see, you are giving that guy, any executive director, you are giving him this amount. Okay, whether professional or not. So why this separate category? I don't know, because Act does not contemplate any special category of professional capacity director, etc. There's nothing. Guys, see, you got only MD, WTD. This guy will be a whole-time director. That's all. The CFO, who is a director, will be a whole-time director. That's all. I don't know why they put this condition or what they are trying to prevent. Because suppose the MD son is a school dropout, but he can still be a WTD and he will still be eligible for Schedule 5. Because the Schedule 5 has only disqualification. No qualification. There is no qualification in terms of education prescribed for directors of a public company. Be careful. Private company can prescribe by its articles, but public company, listed company, no. You cannot say education qualification. Private company, yes, by its own articles can prescribe any qualification, any disqualification in addition to what we saw in 166 in the last session. But that's different. Public company, no way. Even see, if you prescribe educational qualification for directors, many of these today's large listed companies which are successful on the capital markets may not have come into existence because many of the people who formed them were not college educated, or they were just college educated and they had no MBA degree or professional degree, not even engineers. Many of the guys who set up and ran engineering companies were not engineers at all. They hired engineers, they hired chartered accountants, but they were not engineers. They were not chartered accountants. They were not company secretaries. So some of them were just graduates, some of them were less than graduates. So if you try to prescribe educational qualification, may not be a good idea. Which is why this whole section, this whole provision hangs in limbo. One wonders who is that being attacked here, except the CFO and company secretary, etc., who will anyway be covered. I think they are only saying if a professional is a managerial person and a WTD, then he should not be having the interest in the company. There again, they say holding by any employee of shares not exceeding 0.5% of its paid up share capital. That's huge. 0.5% of the paid up share capital of that company under any scheme formulated for allotment of shares to such employees, including ESOP. Okay? Or by way of qualification shall not be deemed to be interest in the capital of the company. Right? See, a company may say a person to be a director should hold certain shares. If such a condition is there, then if he is holding it, then that will not be counted for interest. Also, if he is holding shares of the company not exceeding 0.5% of its paid up share capital under a scheme of allotment for employees, like ESOPs and all, then to that extent, it will not be taken as interest for this purpose. Right? Now, the limits specified under items A and B of section 2, A and B of section 2, okay? A and B of section 2, these two, A and B. This is A and this is B of section 2 shall apply if these are additional conditions, more like procedural issues. So they are saying, you see, all this is applicable to an year of loss. In an year of loss, I want to go through Schedule 5, Part 2, Section 2, right? No problem. If I want to go through Section 2, then in addition to what we saw, these conditions also should be satisfied. payment should be approved by the board, and where there is a nomination and remuneration committee by that committee. Later on, when we come to meetings of board, we will talk about committees of the board. One of the important committees is nomination and remuneration committee. Certain companies which are required to have an audit committee will also have a nomination and should have a nomination and remuneration committee who will interview the director, who will decide whether this person is suitable to be a director and also fix his remuneration. So the nomination remuneration committee will be there. And usually the chairman of the audit committee himself will also be a member of the nomination and remuneration committee. And MD could also be there. Independent directors also will be there, right? And so that committee should approve this payment. The company should not have committed any default in payment of dues to any bank or PFI or non-convertible debenture holder or any other secured creditor. And in case of default, the prior approval of the bank or PFI concerned or the non-convertible debenture holders shall be obtained by the company before obtaining the approval in general meeting. We had a similar criteria when you wanted to exceed the overall ceiling limit. If you remember, when you wanted to exceed the overall ceiling limit, you said you can if you pass a special resolution. But then they said if there is a default, you have to go and get the permission from these guys, whoever is the default. So they are all protected creditors, like you have banks, public financial institutions, non-convertible debenture holders, secured creditors. Okay. So in case of default, you have to get the prior approval of all these parts, one of the concerned party. In addition, an ordinary or special resolution has been passed for payment as per item A, or a special resolution has been passed for payment of remuneration as per item B at the general meeting of the company not exceeding 3 years. So board, no default, you have to get the approval of shareholders by an ordinary resolution or a special resolution. See, where you are paying him within the limit, ordinary. If you are going to exceed this, then special. That special also should be considered. Then in addition to this, they say a statement should be filed along with the notice. See, 1, 2, 3, now 4. A statement along with a notice calling the general meeting should be, see, when you're getting the approval for paying managerial remuneration in an year of loss. See, you are going to the shareholders. You want to pay more than what is prescribed under Schedule 5. Then you're going to the shareholders. Along with the notice calling the meeting, you should give a statement. Very interesting. You should mention what is the nature of your industry, what is the date of commencement of commercial. It's already commenced. You can say commenced. In case of new companies, commencement of activities, financial performance, they have given a detailed format. In that format, you have to give. If there is any foreign investment or collaboration, you have to give. Also, you have to give information about the appointee. See, now you are trying to get an approval for payment in excess of, or maybe in a year of loss, up to say 84 lakhs or 1.2 crores. You have to justify why you have to pay this guy in a year of loss. So background, who is he? Biodata. Past remuneration. What was he getting in his previous employments? Has he got any recognition or awards? Job profile and his suitability. I mean, this is really, really delicate because sometimes the listed companies may have huge, industrialists as MDs. And now you have to go and justify job profile and suitability. See, imagine writing this paragraph or this part of the form for, say, Mukesh Ambani. What do you think? Job profile and suitability. I mean, think about it. Of course, still you have to fill up this form. You can't just say, you know who he is. Like that, you can't put. Okay? You can't put like that. You have to mention who he is, what he has done and all that. Remuneration proposed. Okay, so, see, this is one thing where, somewhere corporate democracy works. If a company makes, which is why Reliance, Mukesh will never come up before his shareholders for this. Remember, because nowhere in any year has Reliance ever made a loss so as not to be able to pay Mukesh's salary. You understand? Those companies are nowhere near this. These are only companies which are making losses. Obviously, these companies need to say why and who is that fellow MD who did the management and he's got loss. So yes, justify. So they have to mention, okay, why it is happening and all. And comparative remuneration profile with respect to industry. This data is available. Size of the company, CEO salaries are public information. Obviously, because Schedule 5 is a public information once filed, and annual reports are public information. Nothing is secret. There are agencies that cull out this information, arrange it, and provide it as a service. So you can just go industry-wide, they'll give you like that. In terms of salary range, they'll give you who is getting how much, everything. So comparative remuneration profile with respect to industry, size of the company, profile of the position and person, etc., etc. In case of expatriates, you have to give with reference to his country of origin. Pecuniary relationship directly or indirectly with the company, or relationship with the managerial person or other director, if any. So if any relatives are also directors, you have to mention so-and-so is his son, so-and-so daughter, so-and-so father, mother, so that it's a family business. Okay, you have to mention that. Pecuniary relationship with the company means, does he have any other relationship? For example, he is also a director on the board of another company which supplies parts to this company, the related party. Later on, we'll be seeing related parties. 188. Okay, this is not related party. Any pecuniary relationship, directly or indirectly, means either directly with him or with his relative, or a firm in which he is a partner, or a company in which he is a director, etc. Okay. You have to give reasons for loss or inadequate profits. Steps taken or proposed to be taken for improvement. Expected increase in productivity and profits in measurable terms. Very powerful provision where you have to commit. But the problem is, when the notice goes with this, it will be a listed company. Now, most of them are listed or public companies. E-voting will be applicable. Okay, e-voting, compulsory e-voting. The idea of e-voting is shareholders should get a better chance to participate and negate. But the effect of e-voting is nobody bothers to open the mail. It goes and sits in the inbox. Moreover, man will give some email ID for his DP and depository participant. For dematerialized, in his demat account, he would have given one email ID. His regularly used email ID will be different. This mail will go and sit in his demat account email ID, which he may not see, which he may stop seeing. Okay, so on and so forth. So, which is very dangerous, because sometimes, dividend and all, but of course, bank accounts, if you don't operate and you don't take notice of what is coming to you, sometimes you have to take some action and you'll have to close it. If you don't do that, then there's a chance that the money could go to the IEPF and all. So, but the point I'm making is, this will go to his email ID, which he doesn't use. Nobody bothers to see. Very few people will vote. And those votes and all, they take also nothing, special resolution, because the promoter group will vote for. Then they will ensure that the resolution is passed and they'll move on. Again, you have to only take those votes which are cast. Those members who vote, we count. We have a meeting date, on which date some people will come. Online also, you can have a meeting nowadays, post-pandemic. So once you do that, you count the votes and then you declare. Okay, scrutineers will be appointed. It's very, very routine. To my knowledge, nobody has questioned any managerial remuneration. I've never heard it. But still the provision is there, which is why sometimes I tell investors also, see, you are angry with so-and-so because he was doing this, but when his remuneration came up for approval, why did you go and approve it? No, you are not even aware such a thing is there. Your awareness of law is first step. You should know what the law is. Before you start blaming auditors and others, you should ask, the investors should ask themselves, have they participated in the management of the company through the general meeting? Have they involved themselves? Have they taken their vote seriously? Many people don't. So also in the annual report, the director's report, in the financial statement, under corporate governance also, this remuneration package should be disclosed completely. Okay, so you remember what I said? The managerial remuneration is a public information. It gets reported in the board of directors report. And it's available for any company. Listed company, sure. Public company also, yes. You have to go to the MCA website and see. Whereas for a listed company, straight away you can go to the company's website, or you can go to NSE website, or BSE website, or moneycontrol.com. They'll simply help you to download all these statements in PDF form. You can. Okay. In fact, today, the type of data that is available online for company analysts like me is tremendous. When I want to do some research about a company for purpose of acquiring that share, I get a lot of information from the market, all authenticated from authentic websites, not some broker ka website or some financial company ka website. Proper moneycontrol.com, company's own website, NSC, BSC, that I can download it and I can have a look. So many things are possible. So this is section 2 of part 2. Okay. Very interesting, very important from the exam point of view, from a real life perspective point of view also, this is very important. Okay. Because in most cases, in your own life, you would be, asked to give solution to your company with regard to these type of, okay, good. Now moving on, this is part 2, section 3, remuneration payable by companies having no profit or inadequate profit in certain special circumstances. So you're going to see certain special circumstances. So section 3 overrides section 2. In an year of loss or inadequate profit, normally section 2. But if it comes under one of these special circumstances, you will come to section 3. In the following circumstances, a company may pay remuneration to the managerial person or other director in excess of the amounts provided in section 2 above. Means without passing special resolution, because you can pay in excess of the limits by passing a special resolution, right? So without special resolution, you can still pay more than the limits, provided you are able to show that you come under one of the special circumstances, right? So what are these special circumstances? Where the remuneration in excess of the limit specified in section 1 or 2 is paid by any other company, and that other company is either a foreign company or has got the approval of its shareholders in general meeting to make such payment and treats this amount as managerial remuneration for the purpose of section 197. And the total remuneration, the total managerial remuneration payable by such other company to its managerial persons or other directors, including such amount or amounts, is within the permissible limits under section 197. Friends, one of the most unnecessarily complicated provisions. Unnecessarily is the operative word. See, you wanted to exempt foreign company. I have absolutely no problem with that. So you pay more to a foreign company, no problem. Or, okay, or this or is another stupidity. Other company, and that other company is either a foreign company or has got the approval. I don't know what they are trying to do here. I think this clause is meant to link Schedule 5 with Section 197(1). Idea is they are saying sublimits are violated, but the overall ceiling limit of 11% is not violated. So this is a case where you are paying more than 5% to the MD. In an year of profit, you are paying more than 5% to the MD. They bring that under this category. So long as they are saying the overall ceiling of 11% is not violated. Why bring foreign company into this? I don't understand. Because remember, this or and is very powerful. Either a foreign company or, that or is very important. Or, so foreign company is not covered in this or. Once you put an or there, straight away foreign company is out. The other company, other than foreign company, has got the approval of its shareholders, treats this amount as managerial remuneration, etc. Now, the word foreign company is defined in the Companies Act, but that's not here. There's a separate chapter when you will be taught. Not me, somebody else will teach you foreign company. See, there are two types now. A company incorporated outside India, one, and a foreign company, which has a place of business in India. So, the slight difference. There are a lot of companies incorporated outside India, but not all of them are foreign companies under the definition. Okay. So, just for your information, when you come there, it will be taught in depth. Now, So see, sometimes I link these topics to you because make a note of it, and when that topic comes, link it with this topic. That way your connection will become. So foreign company can pay beyond the limits of 1 and 2, no problem. Any other company, sub-limits can be violated, so long as you are within the overall ceiling of 11%. Okay. I only said Schedule 5 is interesting. I never said it was easy. Okay. Sorry. But that's the problem. I mean, it could be very easy if only they don't make it so unnecessarily, confusing. And again, what is the intention is also not clear. So usually, when in those days, in the old law, when I read a section, I could easily make out what is the intention of Parliament there. Okay, because the words of the section were so clear that the intention was very clear. In fact, you could, yes, this is correct. But here they themselves, see, the use of language is so poor. They keep confusing. And so you end up with a lot of confusion. And believe me, many of these topics, see, today, the ultimate horse's mouth for company law is company secretaries. So sometimes I have been a teacher of the Institute of Company Secretaries since 1992. I have been a teacher for company secretaries since 1992. So nowadays, with this type of a new law coming, nightmarish law, I've thrown up my hands and I've said, look here, my ability to understand your law is so restricted. You tell me what it means, because you guys are the chief priests. You are the pujaris of the temple in the MCA. You guys have all the control over this law. You tell me what it means. They will go through that section again and again and again and again. Finally, they will send a text message. The company secretary will send, sir, even I am not clear. Can you explain to me? How can I explain something that you guys have confused? So then, this is what I am trying to do here. So all I am saying is, foreign company, free. You pay whatever you want. No need to pass special resolution, etc. Any other company, you have to pass a resolution, and the limit, sub-limits can be exceeded. Means you can pay more than 5% to your MD, etc. More than 5% to one MD, but total overall limit cannot exceed 11%. That overall ceiling is not to be violated. And finally, what happens is, with this section, your 197.1 gets linked with Schedule 5. So that, as I already mentioned, Schedule 5 is not an exception to 197. Schedule 5 operates within the 197 frame, right? And another beauty is, in section 2, we are talking about loss or inadequate profit. In an year of loss or inadequate profit, Baba, where is the question of percentage of profit? You will have to go only through effective capital, right? So seriously, 2 doesn't make any sense here. Whereas for foreign company, section 1, 2, etc., no problem. You pay whatever you want if you are a foreign company. Simple, because he's bringing his money, he's making money. Let him take whatever he wants. That is the point. Of course, we'll tax it. Before the foreign director takes the money out of India, TDS has to be deducted and remitted to the government of India. Only then the money can go out of India. See, actually, according to me, there is a stringent control here. Need to be here, where taxation-wise, we have to be very clear whether they are playing some game on taxation, etc. But by and large, my experience is, with corporate rates being so low in India, as low as 25%, you are better off paying the tax in the company's hands rather than take it out. This is what I found. We are still in special circumstances where the company is a newly incorporated company. For a period of 7 years from the date of its incorporation, Schedule 5, Section 1 and 2 will not apply. No limits. Go on. Is a sick company for whom a scheme of revival or rehabilitation has been ordered for a period of 5 years from the date of sanction of the scheme of revival. See, remember, this is already a sick company. It has incurred heavy losses and has now gone to the BIFR, erstwhile BIFR, and has sort of gone for some kind of a restructuring, reconstruction plan. Obviously, for the next 5 years, they may not make profit. Now, somebody has to come and run that company, right? Believe me, reviving a sick unit is a greater challenge than running a profitable company. And that gentleman should be paid salary, reasonably. So there, if you start putting conditions based on effective capital, because sick company might have gone for reconstruction, in which case they might have gone for reduction of capital, losses. So where is the effective capital? So we cannot. So they say for 5 years, limits don't apply to you. Go ahead, pay whatever you want. 197 doesn't apply, section 1, section 2. You go ahead and do whatever you want. Okay. Is a company in relation to which a resolution plan has been approved by the NCLT, National Company Law Tribunal, under the IBC, the Insolvency and Bankruptcy Code. See, once a company is potentially insolvent, any creditor can approach the tribunal and obtain an order of insolvency. Before passing the order, the company will be given an opportunity to represent, etc., etc. But at the end of the day, if the tribunal is satisfied that this company is insolvent, then they may, or potentially insolvent, both are possible, then a resolution plan will be presented to by the creditors or by the management of the company, and the tribunal will approve the plan, and the resolution professional will be appointed. See, this is nothing but the BIFR has now been dismantled. Instead, you have the NCLT and the IBC, the Insolvency and Bankruptcy Code, which is there in your syllabus. You are studying the IBC. Hopefully, for a short while, it's going to be there. So you'll need to know what the IBC is, the Insolvency and Bankruptcy Code. Basically, when a company has gone under the IBC, see, popularly, Insolvency and Bankruptcy Code is called IBC, and National Company Law Tribunal is called NCLT. Standard abbreviation. Even in the exam, you can use NCLT. Yes, you can use the word NCLT or tribunal. Both are equal. Tribunal, appellate tribunal, or NCLT, NCLAT. But before you write NCLT, once at least you write the whole word. And then you write within bracket NCLT, and thereafter use NCLT throughout your answer sheet. No problem. Okay. So these are some special cases, right? Again, where the remuneration of managerial person exceeds section 2, but the remuneration had been fixed by the BIFR or the NCLT. See, this is where 2 and 3, where BIFR has not fixed anything. NCLT has not fixed. It won't apply for 5 years from the date of commencement of resolution plan, from the date of commencement of reconstruction. See, why they have included BIFR? No, today, no company will go for a financial reconstruction because BIFR itself is not passing orders. But there could be companies which have already gone, especially if they've gone to the appellate appellate board for industrial financial reconstruction, then the orders may be coming. So now their period may start. So those cases only, which are currently pending before BIFR or the appellate body, only will come under this clause. Otherwise, fresh cases all will come only under IBC. Now, so IBC is one beautiful area where there's a lot of scope for chartered accountants also, but then it's actually a very, very specialized area. You might want to look at it as an option. Consulting option, actually. Very, very fantastic consulting option. It's very interesting. So that's why Institute is also got a, what is that? Paced paper. That is where you take it at your own pace, or specialization paper. You can go through that. If sublimit is violated, the company have to permission from CG, and here it is in special circumstance. So, see, if sublimit is, let me go back to that slide. Simple. See, this is the slide where sublimit is exceeded. I think you are confused with permission of CG. See, permission of CG will happen only where you are not eligible to come under, that director is not eligible to come under Schedule 5. Okay, if he is not coming within the purview of Part 1, then and only then you will go to the central government. Merely exceeding the limits now, okay, you can just get an ordinary resolution in general meeting for exceeding 11%. Or sublimit violation, you can go to special resolution. So you go here. Whereas here, you see, mainly section 2. In an year of loss, you have to pass a resolution or a special resolution. That is not needed in special cases. Got it? That is not needed in special circumstances, especially in an year of loss. In an year of profit, if you want to exceed the sublimit, that is why this A is there. You understand? A is a case where you are exceeding sublimit within the framework of 197.1, no problem. That is an exceptional case. You pass when the sublimits are exceeded, there is no need to go to the permission of CG. Maybe you have somewhere you have missed it. I'm again confirming it. Permission of CG is not required. When profit is there and you're exceeding the sublimit, you can go get the approval. But profit is not there. Then section 2. If you want to go through section 2, then you have to comply with schedule 5. If that person is not complying with schedule 5, then you have to go to central government. You got it? Or you want to exceed 11%, right? But that's inadequate profit. Then again, you have to go through section 2. If the person is not satisfying the criteria of schedule 5, then and only then he has to go to central government. Otherwise, within the framework, you can simply get approval and go. That is why this A is there, to link a case where sublimits are exceeded, but special resolution is passed or resolution is passed. This is coming under special circumstance. Go ahead, no problem. No need to go to central government, etc. Okay, I hope I have been able to communicate to you. Again, be corrected. If sublimit is violated, the company has to take permission of CG. No. Only special resolution for sublimit, ordinary resolution for overall limit. Okay. So just go through, after my lecture, just to go through this part again with more clarity, you'll suddenly realize the special circumstance is nothing but 197.1 where their limits are exceeded. Sublimit is exceeded. They're simply bringing it here as an exception case. That's all. This realization took me 2 days. I read it. Luckily at the time it was pandemic. So I had a lot of time to think. And finally I came to this conclusion. Ms. Darasha, are you clear? I asked tongue in cheek because it's not easy to understand. But in case you are clear, do confirm. Okay, now the above exceptions under section 3 are subject to the following conditions. The company should meet all other, so many conditions in schedule 5. That is why, in fact, what schedule 5 needs is not, actually there's a need for a manual. I wish the ICSI would do this so that they should clearly say checklist, and only then you have to go. Remember one more thing. A company secretary may be giving some advice to the company about managerial remuneration. No problem, let him give and go, let her give and go. Finally, you are the auditor. You have to sign on the balance sheet. Now, you should ensure that the managerial remuneration is within the limits, because suppose you've signed the balance sheet and the remuneration is wrongly computed, the company secretary's opinion has no value to the MCA. They will simply ignore it. They will say, no, that is okay. No, you are the auditor. Why did you allow? And you will be in trouble. Therefore, you have to be careful while approving. Yeah, means in special circumstances, no need of approval. No, madam. In special circumstances, where a company passes a special resolution or a resolution, that is a special circumstance. No need for approval of CG. Got it? If the company passes a special resolution or a resolution, as the case may be, then no need for CG approval. That's all it means. Okay. Subject to, again and again I'm saying, CG approval will be needed if the guy is not capable of being appointed under Schedule 5. Sublimit means these limits, these are sublimits. See, your question is very, very, single word, sublimit question mark. I'm assuming you are asking what are the sublimits. See, you can pay managing director or whole-time director only 5% of net profit. Suppose in 1 year you want to pay MD 7%, more than 5. Got it? You can, provided you approve it by a special resolution. That is what sublimit means. Okay. If you want to exceed 11% itself, subject to the provisions of Schedule 5. Now see how they are linking one end is on one end. This, you can do anything you want within that. If you want to go beyond it, 11%, then Schedule 5 will apply. Then automatically you have to go to central government for approval. Okay. So within 11% sublimit, you play around, no need for approval of CG. You want to exceed that 11%, sorry, you have to go to central government for approval. Right? Sublimit, no need for central government approval. So long as you get the special resolution of the, that is why they are including that as one of the exceptions here. But if you're exceeding 11% in any year, you will be year of adequate profit, you are having profit, but you are paying more than 11%. You have to go to central government. You are paying more than the effective capital, where the effective capital can only give 1.2, you want to pay more than that, you have to go to central government. I'm sorry, you have to pass a special resolution. But if the guy is not capable of being appointed under Schedule 5, then you have to go to central government for approval in an year of loss. In an year of profit, where an adequate profit is there up to 11%, nobody can ask you anything. All the Schedule 5 story is only for year of loss. In the year of loss, what to do? That is the issue. Okay. Okay, moving on. I do agree. It's little, I'm happy that you got it, Mr. Jain. It took me a lot of time to get it, as you say. Okay, because I agree with you that this is not possibly the best way of drafting. Nevertheless, okay. So as I was telling you, as of course if you're going to be in service, if you're going to get into advanced investment banking, or if you're going to get into advanced corporate finance, maybe this subject may not be relevant to you. But unfortunately, you need to know the basics, right? But if you're a CFO of a large company, okay, handling all aspects of finance for a large listed company, then every year this is going to be a nightmare for you. Every year. Because if the company is not making money, you should still be able to pay your managerial personnel. So you have to quickly take a call. Should I go to central government? And you appoint them under Schedule 5 anyway. You should ensure that they're eligible, so on and so forth. Okay. So that is the point. Thank you, all of you, for confirming that you have got it. Good. But don't worry, in the examination, do not expect something so complicated as special circumstances, sublimits and all. Maximum what they would ask you is something where they would give you the balance sheet of similar to what I've asked in my assignment. If you're able to solve my assignment without support, without referring to my answer, that's why I've not given you the answer. If you're able to answer it, understand and answer my assignment, get the right answer, I think you are there. Okay, I think you are there. Other than that, don't expect something too complicated, because CA exam is more on application oriented rather than they are really keen on knowing whether you are able to apply the law to a given set of facts. They don't complicate it and try to tease you. That's not the idea. Okay, it's not the idea. That way, if you go for practical situations, very complicated situations are there. Personally, I have the same managerial remuneration under the old Schedule 13. I have got a lot of conundrums. And finally, we have to come out with some. See, usually the management would like to avoid going to central government. But if nothing can be done, then you have to go to central government. There's no other go. Okay. And you have to get the approval. And it's not some impossibility. You just go there, meet the regional director, explain to him what the situation is, help him to understand the need, and he'll give you the approval. So you have to meet all other conditions prescribed under Section 2, except ceiling on remuneration. Got it? The managerial person should not be receiving remuneration from any other company. The managerial person should not be receiving remuneration from any other company. So in an year of loss, you cannot get remuneration from any other company, right? The auditor, but again, there will be one more case where they will say, you can pay in more than one company. We'll see that. For MD alone, they'll say. The auditor or company secretary of the company, or where the company has not appointed a secretary in wholesale practice shall certify that no objection certificate has been obtained from all secured creditors and term lenders for the appointment and quantum of managerial remuneration. Okay, so you have to go to all the secured creditors and term lenders. That is, those who have lent for a long term, like banks, financial institutions. They are the main term lenders, and you should get a NOC. The auditor or CSR, nowadays, this particular certification, generally, we leave it to the whole-time practicing company secretary. They do it. So after all, in those days, we used to do it. But nowadays, we generally practicing CAs tend to avoid certifying MR1. So when it comes to that, because we say, after all, that guy is there, ask him to do it. So, or we ask the company secretary to come and see it and sign it. And they just come and have a look, and if they're satisfied, they sign it. So the auditor or company secretary or the company has not appointed a secretary in whole-time practice shall certify that there is no default on payments to any creditors and all dues to deposit holders are being settled on time. Okay. We already saw this. For both part 2, section 1, 2, and 3, this definition applies. We already saw now, section 4 of part 2 talks about perquisites. See, while defining remuneration, we clearly said all perquisites as defined under the Income Tax Act are to be included for managerial remuneration. So, while applying the limits, we should take his salary, any commission received by him, and all perquisites, we have to compute it under the Income Tax Act. That total figure we should have. That number should be compared with 5% of the profits. Are you able to understand? So we should see totally how much you have paid him. That total should not be more than 5% of the profits. So perquisites covered under the Income Tax Act are includable. Here they are saying certain items are to be excluded. You'll be seeing that they are not very, very powerful exceptions. It's a normal exception only. Okay, these should not be included for computation of ceiling remuneration. Contribution towards PF, superannuation fund or annuity fund. See, PF is compulsory provident fund. There are some high-paid employees, especially in this category, for whom a separate superannuation fund would have been set up by the company and managed by the company. Any contribution to that fund or an annuity fund means pension fund, you can say, for high-paid employees, PF will not be applicable. Therefore, the company itself will set up a superannuation fund or annuity fund. Any contribution to the company will make a contribution. Employee also will make a contribution. It will be it will be working under certain rules. And so anyway, this amount is not taxable under the Income Tax Act 1961. Therefore, here also not taxable. Okay, here also not to be included. Gratuity payable at a rate not exceeding half a month's salary for each completed year of service. Okay. Gratuity payable at a rate not exceeding half a month's salary for each completed year of service. You know that, the gratuity. So gratuity not to be included for remuneration, managerial remuneration. Encashment of leave at the end of the tenure. See, these are anyway exempted under the Income Tax Act. They are simply including it here and saying not included in perquisites like that. Because many companies have this nasty habit of including these 3 items in the CTC. I've seen that. Many employees, they'll bring the CTC, they will include gratuity. See, they will say, 5 years if you work, this is a gratuity you are eligible. So, annualized basis, they will include it in the CTC and show. So that his CTC will look fat, nice. But basically, he is going to get it only at the end of 5 years. Or when he is retiring, or when he is resigning. Till then, he won't get it. And if he resigns it less than 5 years, they may not even pay it. But still, they try to take. PF contribution, they will include. That is employer's contribution, they will include. Leave, they will include it here and show in CTC. So they're saying whatever may be done, it is not to be included for remuneration. For an expatriate managerial person, expatriate, okay, that is somebody who is a foreigner or a non-resident, okay, who is coming from abroad. okay, shall be eligible to the following perquisites. See, a guy who's been resident abroad. See, this is another very peculiar thing I find. Of course, this is my view. See, but what some people, they continue to hold an Indian passport. They call themselves non-residents. They non-resident Indian. Okay, there's a lot of difference between a foreign citizen and a non-resident. NRI is, see, under the Income Tax Act, there are certain sections applicable to foreigners, and certain citizens applicable to NRIs. Unfortunately, some of these guys who are foreign citizens, they will claim to be NRIs. So the minute somebody says I'm an NRI, I tell him, boss, whether you are NRI or not, I will decide. You answer one question, just one simple question. Which country's passport are you holding? No, I'm having OCA card. Boss, forget OCA card. You are overseas citizen of India, agreed. Salute you, Mera Bharat Mahan. But just answer this one simple question. Which country's passport you are holding? I'm holding US passport. I'm holding UK. So you are a citizen of US. Or if he says, no, I'm having Indian passport, then OCA itself is not needed. So I'm having Indian passport. Chalo, you are an Indian. So you are a non-resident Indian, agreed. But if you are holding a US passport, you are not a non-resident Indian. You are a non-resident. Okay? Yes, you are a person of Indian origin. Right? You are a person of Indian origin. For that, there are certain benefits. So I need to know where to put you. Only then I can say whether this section applies to you or not. Because there are certain facilities for NRIs which are not available to citizens of a foreign country. Just giving this background to you to ask you to be careful, which is why guy describes himself or herself as NRI. Just ask them, please show your passport. Please submit copy of your passport. Let me decide whether you are NRI or not. Okay. Even, I mean, this is a view that I've been on. Sometimes they get a little upset also. Why you are not? I'm an Indian. See, if you are Indian, no doubt about it. But currently, you are holding passport of US. So, the citizen of United States of America. That's all I need to know. Thank you. You are an Indian, sir. Don't worry. In your heart, you will always be an Indian, etc., etc. Give them the patriotic speech. But application of law-wise, there will be a total difference. Okay, that we'll have to help them to understand. This happens because most lay people, they tend to misrepresent facts. As a future professional, remember, most lay people, especially, say, forget me as a practicing chartered accountant. Many of you will become CFOs of large companies, okay, and or taxation manager of a large company. In which case, many of your colleagues will misrepresent themselves. They'll come to you and give you some facts. But you will have to go deeper than that. And finally, bottom line, their word of mouth or even email is not enough. Show me proof. Sometimes I've had this query from and some people, not my own clients who know me well and they know what I'm talking about. And they know if I'm asking for something, it is in their interest and not because I enjoyed the process. But there are some new people who come or referees will come or directors of companies will come and they will be asking, Mr. Shrikant, do you not believe me? Do you not believe me? Like that. I'll tell him, sir, I'm a practicing chartered accountant. I am not paid to believe. I'm paid to audit. Okay. So kindly give me the proof. Take pride in this. You and I, we are not going to be paid to believe. We are going to be paid to verify and audit and conclude. Okay. This is, hold it as an important aspect of your, profession. Being proud of yourself. Just like a doctor is proud, you can't go to a doctor and say, believe me. He'll examine you and then only he'll give you the diagnosis. Similarly, a chartered accountant cannot believe you. You give the facts, then I will diagnose and give you my solution. Okay. Be clear on this from day one with clients and with colleagues or even with management. Don't, if the managing director gives you some bullshit, tell him, sir, absolutely correct, sir. You are 200% correct, sir. But can I please have the documents? Okay. I'll ask them to send it to you. Then the paper will come, then you will see a totally different story. The agreement will tell a totally different story. Read the agreement fully. Then see what is the contractual obligation. Then see what is the financial obligation. Only then can you talk about the accounting aspect of the transaction. Okay, based on somebody's statement, if you go for accounting entries, later on in audit, you might be in trouble. Okay, coming to the point which we are starting, suppose this guy is an expatriate managerial person, right? For him or her alone, children's education allowance, okay, in case of children studying abroad, to a maximum of 12,000 per month per child, or actual information, whichever is less, okay, up to a maximum 2 children exempted, not to be included. Holiday passage for children studying outside India or family staying abroad, once in a year by economy class, or once in 2 years by first class. I don't know, leave travel concession. Okay, so on and so forth. Okay, so this is exempted. While calculating, you need not include. That's all. Now, they use the word family here. Family. So they define family. Family means spouse, dependent children, dependent parents of the managerial person. Spouse, dependent children, dependent parents of the managerial person. Okay. The nomination and remuneration committee should take into account the financial position of the company, trend in the industry, the appointee's qualification, etc., before they finalize the remuneration. The idea is the nomination committee should be in a position to bring about objectivity in determining the remuneration package while striking a balance between the interest of the company and the shareholders. Means, if too much is paid, the shareholders' profit will be eroded. If you pay too less, you may not get the right candidate to come and do. In the long run, the shareholders will be benefited by the right candidate if you pay the right salary. So this is the delicate balance you have to strike. You pay the correct amount to the guy, nothing less, because then he won't come. You get the right guy who is suitable, so that ultimately he will increase the profitability of the company, and thereby the shareholders will get a benefit. Which is why the nomination committee usually will have people from who have sort of retired senior executives from large corporates, will be independent directors. You'll have people who have held office as director HR of a company. He will be the independent director here. Who would have hired his CEO, who would have been on the hiring committee for his CEO in his company. He would come and sit here to decide about it. Okay. This is a very famous definition. I like this definition. One of the great examples of stating the obvious, okay, or stating something that everybody doesn't need to be stated, but then they want to be clear. So for clarity, they say negative effective capital means effective capital which is calculated in accordance with this section or with the provisions contained in explanation 1 and is less than 0. So effective capital, how to calculate, is given in explanation 1 to schedule 5. Now, or rather section 2 of schedule 5 has explanations. This is the 5th explanation. The first explanation gives calculation of effective capital. You calculate it based on this. This is the summary of the explanation, and you come to a number which is less than 0. That is called negative effective capital. Wow. Negative means less than 0. Thank you for clarifying that. Fantastic. Now, part 2, section 5. Okay, part 2 is like a never-ending story. Part 2, section 5. In fact, this is it. After this, it will all be downhill. Section 3 and all procedural. I'll be even skipping it and some of it and going. Very important. Very important. Remuneration payable to a managerial person in 2 companies. Remuneration payable to a managerial person in 2 companies. Means, can a person be a managerial person in 2 companies? Yes, he can. WTD cannot be. I already told you. But MD can be. Manager can be. You can have, same person can be MD or manager in 2 companies. Allowed. WTD cannot be. Only 1 company. So when he is an MD or WTD in 2 companies, how do we pay the remuneration? Subject to the provisions of sections 1 to 4. So you have to apply 1 to 4. A managerial person shall draw remuneration from 1 or both companies. Okay. But this is subject to the provisions of sections 1 to 4. In fact, in my assignment, I might have made one mistake. Let us see if one of you can find it out. See, point is, one of the conditions we are seeing now, if you want to pay in excess of section 2 limits, then if you want to pay in excess, that is, if you want to come under the special circumstances, then the managerial person should not be receiving remuneration from any other company. So, if you MD of 2 companies and 1 company is making loss, and you want to pay more than the schedule 2 limits, please understand. There are two companies. He's MD in two companies. One company making loss, another company profit. Then you have to see if you want to pay more than this amount, then he cannot receive in both. He can receive in only one. Got it? Because this doubt you will get. That's why I'm clarifying it once more. So he's MD in two companies. He wants to take remuneration from both the companies. They say, no problem, you go ahead. But the total remuneration drawn from both the companies, the two companies, does not exceed the higher maximum limit admissible for any one of the companies. In my assignment, there is a question on this. When next session, I thought I could take up the assignment and explain them to you one by one. But anyway, you can, or if today time permits, I will do it. So, but the point is this. You have to see what you should do, You should take each company standalone. You should see, does the company have adequate profit? Okay. Yes. Calculate 5%. Keep it. Then next company, does the company have adequate profit? Yes. Calculate 5%. Keep it. Whichever is higher. Okay. That can be drawn from both. So that higher limit, the higher maximum limit can be taken in both the companies. You distribute it amongst these two companies. That's all. You cannot, your total remuneration from both the companies cannot exceed the higher maximum limit. Suppose one company, you calculate the limit, it comes to 1.5 crore. Another company, you calculate the limit and it comes to 2 crore. Now you cannot take 3.5 crores. You can take only 2 crores, but distribute it in any way you want. Distribute it in any way you want. Okay. Now, the real issue will be where one company is profit, another company is loss. And remember, all other conditions of Schedule 5 to be satisfied. Okay. And you have to calculate effective capital for the loss-making company. See, as per effective capital. Okay, as per effective capital, 84 lakhs, for example. Then for this company, profit. Okay, as per this company, it comes to 5% comes to 50 lakhs. Then he can take 84, higher limit, but from both. Means the total amount should not exceed 84. How you distribute it is your choice. But the total cannot exceed 84. The higher maximum limit admissible from any one of the companies. I have given an assignment problem. So you can check it out. Once you work out that problem, you will understand it. Again, remember, suppose one of the companies is making a loss. As per effective capital, it is 84 lakhs. Now you want to pay in this company 1 crore. You want to pay in this company 1 crore. Then you have to go to central government. Now, at that time, you can't get in both two companies. You have to get only from one company where you want to exceed the limits. Or if you're saying you are a special circumstances case, right? You are a special circumstance case. You want to go beyond this, right? Then you cannot draw from the other company. Okay. But in all other cases where you have both the companies complying with everything, no problem, then you see which is the higher, and that only can be paid from both. That becomes a ceiling limit for both. This is there right from Schedule 13. This is not new. This was there in Schedule 13 also. In a short while, we will be seeing circumstances when a person can be appointed as MD in more than one company. Part 3. Okay, as I said, from now on, it's downhill. It will be quickly procedural and all. So these are more like procedural parts. The appointment and remuneration shall be subject to approval by a resolution of shareholders in general meeting. The auditor or the secretary, etc., shall certify that the requirement of this schedule have been complied with. See, that's what I call it as MR1 certification. Because once you appoint him within 60 days, we have to file MR1. That MR1 should be certified by a chartered accountant, the auditor of the company, or company secretary of the company, or where there is no company secretary, a secretary in whole time practice. Okay. And like, give me 1 minute. So, part 4. See how quickly we are running off. Schedule 5, part 4. The central government may by notification exempt any class or class of companies from any of the requirements. As of now, they have not exempted. They have not exempted any companies, but they have given themselves the power under part 4. That is why I said, once you complete part 2, thereafter it is downhill. Means quick. Check, check. We'll go on finish off. So, schedule 5, kadam ho gaya. We have finished schedule 5. Let me pause for, say, 2 to 3 minutes to find out if you have any doubts, anything you want to ask me, any quick queries you want to ask me, etc., etc. Because from now on, we'll be going into other aspects of managerial remuneration, right? Now, here's a case where, see, you pay him, see, you can't wait for everything to be approved by the shareholders, etc., before you start paying the guy remuneration, right? Because he's also a guy who has to run his family, boss. So you keep paying him. And then later on, you arrive at the profit, and then you find that it is not adequate, blah. Then schedule 5, then you go, approval is not given by shareholders, etc., etc. Central government does not approve, something goes wrong. This is extreme disaster. Okay, don't even imagine you should get involved in this situation. The whole point of you being CFO and I being auditor is we should avoid this. We should ensure that whatever remuneration we have already paid at least should be retained. Got it? But if by circumstances beyond the control, something happens. If there is any excess remuneration, then that remuneration, if any director draws or receives directly or indirectly by of remuneration, any such sums in excess of the limit prescribed by this section, meaning 197, any such sum in excess of the limit prescribed by this section or without approval required under this section, then he shall refund such sums to the company within 2 years. So earlier it was immediately. Now they are saying, hey, it may be a huge amount, fellow would have spent it. Let him earn and give it back within 2 years. Or such lesser period as may be allowed by the company. And until such sum is refunded, hold it in trust for the company. So this is really dangerous. Huh? You pay him more, then he has to refund it. The company may waive, W-A-I-V-E, waive. Waive means set aside. They might say, maaf. They might say you are excused. Don't pay. Don't repay. Keep it. The company may waive the refund of the above amount by passing a special resolution. Within 2 years from the date, the sum becomes refundable. Okay? But where the company has defaulted in payment of dues to any bank, PFI, etc., etc., then the prior approval of such creditor should be obtained for waiving the refund. So process is like this. Excess has been paid. Man should refund it within 2 years. But the company has the power to waive it by passing a special resolution. Board cannot waive. You have to go to the shareholders and get a waiver. Okay. So all this is nasty. Don't even go there. The law is there. Just know that this provision is there. Don't even practically think of getting involved in this situation. That is why well beforehand you should plan. Profit planning should be done so that by 31st, by easily February, you should know what your profit is going to be. And by February, you will know what your director's salary budget is going to be for next year. Obviously, you will give him increment. Now, if everybody takes an increment in April, MD also should get an increment, boss. So when you put all that, the numbers are there. See, as a finance professional, remember, your number may not be accurate, but your number can be near the ballpark. In fact, your ability to arrive at such ballpark figures and work around them is your greatest skill and experience as a finance professional. If giving, see, in the examination, you are going to be so used to giving accurate answers. Especially right up to +2, right up to college level, you are being highly rewarded for giving correct answers. When you came into professional course also, to a great extent, correct answers were there. But here we gave you some amount of flexibility to give your opinion, view and all. Okay, but when you actually get into practice I am equal, whether you are in practice or whether you are in service, the demand from a professional chartered accountant is going to be the same. Merely because you're in service doesn't mean the talent that is expected to come from you is less, or that practice it is more. Both are equal. And so the expectation is going to be there. And one of the important expectation will be, sir, your MD will call you for a meeting, or a quick committee meeting will be done. Mr. CFO, kindly join us. On the spot, they will ask you a question. On the spot. You can't simply say, sir, I will refer and get back to you. You will. So what you can do is give yourself the benefit of the doubt. Tell them, sir, 95% this is how it will be, or give yourself a probability. But sitting there, you have to give them some ballpark number and go. The MD will, even you tell him, sir, today I can't tell you, I will tell you tomorrow. He'll say, boss, I need to know now. Kindly tell me something. He will also give you that flexibility. He'll say, you can be wrong. I will give you flexibility to be wrong, but give me a ballpark. So this ability is something you have to start building. And you should be. So quickly we should know what will be the profit for the current year based on projections, which you already have, which you already given to the bank boss. Based on that only the fellow lent money to you. Assume that there is going to be a little less. See, this is where you make conservative assumptions. Less. Then calculate 5% of that. Then find out what is the salary total. Well, before March, you will know whether the salary is going to be within limit or not. Then immediately decide. Go for a special resolution. If it is Schedule 5, if you have already appointed him under Schedule 5, no problem. Otherwise, if he's not eligible or some other, you have forgotten to appoint under Schedule 5, then immediately prefer an application to the central government and ensure that it's approved. So that by March, April, May, June, approval should come. And there is no need for any refund, proceed to pay. This is an ideal world. But if this does not happen and somebody has been sleeping, okay, then this section will apply. Refund of the sums to the company will apply. There again, you can waive. So give that as a solution, etc., etc. Okay. See, where a company has a company secretary, by and large, your role may be slightly backseated. Why? Because he or she will give all these inputs. But even they will need numbers from you. They may not have the numbers. So they will expect you to provide the numbers. Right? Every listed company shall disclose in the board's report the ratio of, this is only for listed companies, the ratio of the remuneration of each director to the median employee's remuneration. Are you able to understand? So, MD, salary, then you take the entire, all employees, including the managerial personnel, right down to the security man, right down to the worker, everybody. And then you don't find the average, mean. Average can be very dangerous. That is why they are saying median, the median employee. So you have to bring, I'm sorry to conduct a lecture on statistics, not far be from me any such intention, but you remember your +2 statistics class, where you have a median. So you convert it into frequency distribution. Say, for example, 0 to 50,000, 50,000 and 1 to 1 lakh, 1 lakh and 1 to, like that, till you come to MD. 25 lakhs to 50 lakhs, 50 lakhs, 1 to 1 crore, 1 crore and above. So you have frequency distribution. Then you plot them. Then you start, there's a formula for median, or you find out the exact midpoint. See, what is that salary? That is the median salary. The exact midpoint in that frequency distribution, the exact midpoint. See, what is that salary of that frequency distribution? The median salary, the median of that frequency distribution. Maybe you might get something like, for example, 2.5 lakhs. MD is getting, let us say, for example, 1.2 crores. So 1.2 crore divided by 2.5 lakhs. What is the ratio? That has to be disclosed in the board's report. So just an information. That's all. So that people will know how much the MD is getting. Above the median. So is he worth that much? The question will be raised. Like, okay. This is a more of a statutory requirement. This is coming under Rule 5. Sometimes premium paid on insurance is taken by a company on behalf of its MD, WTD, M, CEO, CFO, or CS. All these people are KMPs. Remember, they are all key managerial personnel. For indemnifying any of them against any liability in respect of any negligence default, misfeasance, breach of duty, or breach of trust for which they may be guilty, and in relation to the company shall not be treated as part of the remuneration payable to any such personnel. See, I'll tell you how it works. There is a penal liability under the Companies Act. Okay. Also, there is a civil liability where action can be taken against them individually for negligence and all that. Okay. Now, so against that civil liability and also the criminal liability, insurance companies may be willing to insure. See, once the insurance company insures, they will take care. See, it's like medical insurance. Anything happens, the insurance company will meet their hospitalization charges. Similarly, they will hire an advocate to represent the criminal matter or to represent the penal liability. Obviously, their goal will be to reduce it. So on and so forth. So whatever premium is paid on such insurance is not part of managerial remuneration. But if such person is proved to be guilty, suppose he is not convicted, then if he is convicted, found guilty, then the premium paid on such insurance shall be treated as part of the remuneration. Right? So this is a very new concept. To my knowledge, not many companies are taking out such insurance. And I doubt if in India whether we have any such insurance products at all, because the risk is too high in India to cover. And the premium may be very high. See, friends, principle of insurance is very simple. If there is a risk, it can be covered. If there is a risk, it can be covered. In other words, if there is a risk, the probability of its occurrence can be calculated, not predicted. Please understand. The occurrence of an uncertain event cannot be predicted, but the probability can be calculated. I hope you're making a very important point here. Okay? Because 100% nobody can predict and say this is going to happen, this is not going to happen. You are not God, I'm not God. But we can definitely bring it down to probability and say, hey, the probability of the occurrence of this event is very high, or the probability of this occurrence is very low. Based on that, we can always fix a premium. But if the premium is fixed, sometimes the premium may be exorbitantly high. It may not be worth to pay the premium because the occurrence of the event may be there. For that probability, you have to pay a high premium. So companies may not take. And so on and so forth. Okay? I mean, this is more of insurance point. But the point is, if such a insurance is there, not to be included normally, but if that person is found guilty, then the premium will be included. Okay? See, friends, my real question to you and to the MCA itself is this, not to you, to the MCA itself is this. Who is going to track all this? How they are going to find out? Huh? Simply, they are adding. See, this is a very important part of, abroad. Most directors on on boards of companies in US and Europe are covered by this insurance. All companies take out insurance for their MD, directors, etc., including non-independent, non-executive directors also. Here they are only covering these guys. Non-executive directors are not covered. There they cover non-executive also. Okay. In fact, many non-executive directors take out professional insurance. Why? In India, chartered accountants actually are supposed to take out professional insurance. Normally, I have not seen any company, any firm or anything, except maybe the multinational firms and maybe some of the bigger firms rarely we'll see a small and medium firm taking out professional liability insurance because the premium is prohibitive and we honestly feel the occurrence is not going to happen. Okay, that's what I think. Anyway, so MD or WTD of the company shall not be disqualified from receiving any remuneration or commission from any holding company or subsidiary of company of the company, subject to its disclosure by the company in the board's report. See, MD or WTD can get remuneration from holding or subsidiary company of the company, so long as disclosed by the company in the board's report. Okay, so they are saying shall not be disqualified. They are saying if you want to take from subsidiary also, you can take, subject to the limits in the subsidiary. You have to take it. The reason is the MD may be managing the holding company. The subsidiary may be coming directly under his control. He may be managing that also, though he may not be MD there. There may be a board of directors there, but he may be overseeing it. So they may be saying, hey, you also take. He can take. Okay. He is not be disqualified from receiving any remuneration from these. Now, the auditor of the company to report whether the remuneration paid by the company to its directors in accordance with the provisions of this section. Whether remuneration paid to any director is in excess of the limit laid down, and give such other details as may be prescribed. With this, I'm sure you have understood why we spent such a long time discussing this detailed provision, even ad nauseum, explaining to you all this. Okay, even at the cost of boring you to death, I have to do this. Why? Because tomorrow you have to certify the balance sheets. And you, in fact, I told you now, who will find out all this? You will have to, as an auditor. You will have to ask them, have you paid any insurance? Okay, during the year, was there any case? Yes, was he found guilty or not? Okay, then checklist. So you have to create your own audit program for Schedule 5. In fact, our institute has given you a beautiful schedule. Don't worry. Our institute has given you a checklist for this, for in auditing. You will study this in auditing also. See, this is one topic where you will come across the similar ugly face in auditing also. I hope this lecture would help you to appreciate it there. Or if you already studied this in auditing, you would be able to appreciate it here. Or maybe a little more clarity emerged post this. Because one of the things that you have to, as part of statutory audit, you will have to do is this. Okay. See, again and again, the liability is being pushed on the auditors. The company secretary who certifies the MR1 goes scot-free, whereas the auditor who certifies the balance sheet gets into trouble even with respect to Schedule 5. Okay, you cannot rely on the MR1 certificate given by the company secretary. You cannot. Okay, that's the point. Now, I will be giving a break at 8 o'clock, right? Okay, so now we come to section 198, which is a very important section. As I told you, not only from the perspective of company law, you might also come across its ugly face in auditing or even accounting. Okay, computing net profits for the purpose of managerial remuneration under section 197. I will try to explain this to you to the best of my knowledge and ability, and I look forward to any interaction from you also. In case you have some views on this, I will take it up. In the meantime, before we enter there, Ms. K. Gayatri, welcome, madam. First time I'm seeing your name here. How the excess paid remuneration will be shown in the financial statements. It will not be shown in the financial statements as excess, because in the financial statement, it will be coming under operational expenses, director managerial remuneration. Definitely, it will be disclosed in the board of directors report. Also, it will be appearing as a qualification in the auditor's report. In the auditor's report, we will be qualifying it. You should qualify it. Or, of course, the director's report also, it will be disclosed under the head corporate governance. When they disclose the managerial remuneration, they should disclose. Okay. Which is why I'm saying, don't go there. Danger, don't go there. If all that has happened, then shame. Don't go there. Okay. So quickly try to get the approval of central government. Get it going. But still, how it will be shown in the financial statement, in the P&L, in the notes, I don't think we can show it. Except maybe in the notes under director's remuneration, you can mention. Yeah, but see, in schedule 2, for managerial remuneration, you have to give the computation. And you have to say what is the managerial remuneration. There you will mention that this amount is in excess. You'll have to disclose it there. As part of the balance sheet, in the notes you will give it. Okay? In the notes. Also, you will qualify. In case they have not got the central government approval and the refund has also not come, either it can be highlighted note item or it could be a qualification. Obviously, it will also be disclosed in the board. But if it is coming in the notes as under managerial remuneration, if it's coming, then directors can also avoid giving it there. Or you can refer to the notes. In your report, you can refer to the notes. You can highlight it and say, hey, read that, what I've told you. The reason is, don't tomorrow say, I didn't tell you. I have told you that this guy has got more than what he is entitled. So finally, it all boils down to you and me. It is only we who will be disclosing it to the central government and shareholders, which is why you should know how to calculate the profit and also compute the remuneration and certify. Okay. Some ticklish items are there. Let us see. As I told you, I'll be giving a break at 8 p.m. Not now, 8 p.m. So bear with me. We used to have one girl who will always ask for a break. Kindly bear with us till 8 o'clock. 8 o'clock, I'll give a nice break. Then we'll again start and go on. So, under section 198, you should give credit. Credit shall be given for the sums specified in section 198.2. What are these 198.2 items? We will see. These are to be added. Any bounties or subsidies received from any government or any public authority constituted or authorized in this behalf. So any bounty means gift. That is our donation given by the government or subsidies received from the government. For example, there might be subsidy, but again, remember, these are revenue subsidies or any capital subsidies, no. Okay. Normally, if it's a revenue subsidy, it will be added to the, but since they say bounties and subsidies, I suppose even capital subsidies can be taken, which is why they are saying you can add. Because if it is a capital subsidy, you would not add it to the PA profit. You wouldn't show it in the P&L account. You would rather show it and reserve and surplus, capital subsidy. But here they're saying you add it. Okay. Revenue subsidy, anyway, it will be added in the P&L as income. So no problem. For computing profit, you would have added it. Credit shall not be given for 198.3 items if credited to the P&L account for arriving at profit before tax. Remember, if it is not credited to the P&L account, why are you again not giving credit? It has not been taken. But if it is taken, if it is credited to the P&L account, you should not consider it. A. Profits by way of premium on shares or debentures of the company, which are issued or sold by the company, unless the company is an investment company. So, where premium is collected on issue of shares or debentures, which are issued or sold by the company, exception is investment company. Okay? In those cases alone. Otherwise, any security premium on shares or debentures, if it is taken to P&L, which is absurd, it will never go to P&L. Unless the accounts department, finance department is absolutely foolish. I don't know how it will get credited to P&L account. Assuming it goes to P&L account, then you have to remove it. Profit on sale by the company of forfeited shares. Do you remember when you forfeit shares and you reissue them, any amount lying in the forfeited shares amount balance will be transferred to the capital reserve. If that item is by any chance taken to P&L account, then that should be removed. Please understand. It's a remote possibility. Proper accounting is done. This fellow will not even come into the P&L. He will go directly to the balance sheet. Profits of a capital nature, including profits from the sale of the undertaking or any of the undertakings, etc. Suppose you are doing a slump sale or a 181A. You are selling the whole of the undertaking. Whatever profit you make there, that should go to capital and it should not be added. Any capital item cannot be taken for managerial remuneration. D is slightly interesting. You are selling an immovable property or a fixed asset of a capital nature, okay, which is comprised in the undertaking. For example, suppose a huge machinery is there, you are selling it. The machinery was purchased at 100 crores. The machinery was purchased at 100 crores. Right, sir? Now, after depreciation, 40 crores depreciation has been charged already. The machinery is now WDV, the reduced book value. WDV of that machinery, after reducing 40 crore depreciation over the last, say, 5 years, is 60 crore. Now you are selling this machinery. For example, it so happens the machinery value has gone up and it's a vintage machine and people are willing to pay. You are selling it for 110 crores. You are selling it for 110 crores. So 100 crore original cost, depreciation 40, WDV 60, now being sold for 110. What is the profit on sale of this asset? I mean, this is too simple for you all, but I'm going to ask you. Mr. Aniket Jain, make a note of these numbers. Original cost 100, depreciation charge till date 40, WDV 60. During there, I sold that machinery for 110. What is the profit I have made on the sale of this machinery? If you give the answer, I will explain the provision to you. Otherwise, the provision will be very difficult to understand. What is the profit? Profit is 110 minus 60. Am I correct? 110 minus 60 comes to 50 crore. Now, if this 50 crore is taken to the P&L account, it's a profit from sale of immovable property, which is credited to the P&L account. Okay, then that 50 crore should not be considered. Capital profit should not be considered. How I got 50 crore? Sale value minus WDV. Standard accounting procedure. Got it, sir? Exception. Where the business of the company is buying or selling property or assets. See, it's a construction company or a real estate company. Then they will be buying and selling assets. For them, it is stock in trade. Technically, it is not fixed asset at all. Okay, it is stock in trade. In those cases, obviously, the profit of the company is arising from sale of immovable property. Yeah. So that will go to profit. There, no problem. But if the business of the company is not buying or selling of property or assets, then any profit from sale of immovable property or fixed assets of a capital nature, example I gave machinery, comprising the undertaking or undertakings is not to be considered. If it is credited to P&L account, it should be reversed. It should be deducted. I gave a numerical example. I hope some of you got the correct answer. Darasha gives me the answer. Be careful. Now this 50 crore consists of two parts. One is original cost minus WDV. Okay. Original cost minus WDV, which is 40. Depreciation charge. And the sale value minus original cost, 10. So your 50 crore consists of two parts. One, the depreciation charged, okay, up to date, which is included in that 50. And 10, which is profit over and above the original cost. Now they are saying where the amount for which any fixed asset is sold exceeds the written down value thereof. Credit shall be given for so much of the excess as is not higher than the difference between the original cost of the fixed asset and its written down value. Now, suppose you read this proviso without my numbers. It may take a little time for you. But now with the numbers, it's clear now. 100 crore original cost. Written down value 60. Difference 40. Profit 50. So out of that 50, 40 is allowable. 40 can be added. Only 10 should be removed. Let us say 50 crores has been credited to the P&L account as profit on sale of fixed asset. No problem. P&L account item, it goes to P&L account, nothing wrong. Except that for IT purposes, it will be totally different. That's different, but okay. But as far as managerial remuneration is concerned, normally I should add back 50. No. Read the provision, then you will understand. You should not take 40. 40 should be kept in P&L only. Only 10 can be taken. That is to the extent of difference between the original cost and written down value, which is nothing but the depreciation charge, is allowable, can be included in profit. Anything over and above the original cost only should be taken, right? This is possible in rare cases. But in any other case, what will happen? You will sell above the WDV, in which case all profit consists of depreciation. Am I correct? It's because the journey is between the WDV and original cost, right? So any number between these two, fully allowed. You need not bother. So this is something you might want to take. So I hope, because I have not given I have not created a PPT for this example. I have given it orally. Are you clear? Okay, good. Now, any change in carrying amount of an asset or of a liability recognized in, see, that's why I gave this numerical example, because without the numerical example, it will be very difficult. This is also a suggestion to you, whenever you have a doubt with any provision in the Act, which involves calculations, not only here, in income tax, in GST, wherever, take out a numerical example and see it. It will fall in place. Recently, section 45.4.4a and all came. 4A, the new, where a partner, there's the retirement of a partner and he's taking some assets or other, thing, and what happens, etc., etc. Okay, huge provision is very complicated. Luckily, the CBDT gave a circular in which they have given a beautiful numerical example. If you read that numerical example, 4A and 4 will fall in place. For one of our clients, we had two partners, one partner leaving, another partner taking over the firm, one partner going out with some share of the immovable property. So exactly the year, I kept on telling them there is a proposed amendment, please finish your transaction. Still, while the going is good and the retirement is not covered, etc., etc. They kept on dealing. Finally, they came. The act has been amended. I said, sorry, now it's. So then we did the calculation for them, and I used that numerical example. It was so easy. We took the numerical example, we substituted our numbers there, and then kept on doing, we got the answer in Excel. So just to give you a suggestion. Okay, E. Any change in carrying out amount of an asset or liability recognized in equity reserves, including surplus in P&L account, on measurement of the asset or the liability at fair value. You guys are kings and queens in Ind AS, IFRS, etc., where you know that in many situations, we have to arrive at the fair value. Okay. For the purpose of fair value, what we will do, we will pass a entry, notional entry. That profit cannot be considered for the managerial remuneration. Similarly, any amount representing unrealized gains or notional gains or revaluation of assets. See, sometimes in derivative transactions, when I'm accounting an option or a future, especially an option, I might have to recognize an income even though I have not realized it. I'm sure you are familiar with this. So, especially in options, though tomorrow that may change, market may collapse and all. But as of today, on 31st March, it's in the money. I have to recognize unrealized gain like that. Now, in those cases, such unrealized gains, notional gains, etc., cannot be considered as part of profit. If any of these items, A, B, C, D, E, F, right, have been credited to the P&L account, then they should be reduced. And remember the proviso to D. Okay. Now, before I go on with 198, 198 is pretty long. Before I go on with 198, permit me to give you a small break for, say, 10 minutes. Let's say 8:15. We will start the class again with your permission. Okay. Nisarg, break. So, welcome back from a well-deserved break. Continuing with the topic, though today it's a little heavy, no doubt about it. In fact, later on, as we go to meetings and powers of directors, you'll find things are again going to be a little relaxed and thing. But this managerial remuneration part is not complicated. It has been complicated by the ministry due to their own fears and paranoid behavior. They have created such complications. And another goal which is running through this whole thing, which I can see very clearly, is they want to actually make it liberal. But while doing so, they have made it confusing. It's the only one. But I hope today, to a great extent, we have demystified this and we have tried our best to, sort of make sense out of this. But if you still have any doubts, do feel free to raise queries. It will be my job to answer them. Right? Now, the following shall be deducted. Okay. Yeah, all the usual working charges. This is not something new. This is there in the 56th law also. All the usual working charges, right? So all the usual working charges, everything, okay, will be taken. Salaries, purchases, okay, you name it, yeah, all the expenses. They are saying you should deduct director's remuneration also. Not very comfortable about this. What do they mean by director's remuneration? God only knows. Because you are computing 5% of this profit. How you can compute it after reducing director's remuneration? So I humbly suggest that you should not. If director's remuneration has already been reduced, you have to add it back. Only then you have to calculate. Am I correct or not? Because you are calculating the MD's eligibility. How you can reduce the MD's already? Suppose he has drawn some salary, you reduce it, then the whole point is lost, right? So my suggestion is you should not. But the way it looks like it is, you should reduce the MD salary also and then arrive at the profit. On that profit, you calculate 5% and see whether this remuneration is correct or not. It's absurd. Should add it back, calculate 5% and then see what I do. Anyway, see, just like partner's salary, you can see, could calculate the percentage. You ought not include partner's salary. If you already paid the salary, you add it back, then compute the percentages as per the 40B, and then you decide whether he is within the limit or above the limit. Am I correct? It's a natural calculation. Surprising. This B is not clear to me. If any one of you has got better handle on this, I'm more than happy to I'm more than happy to listen to you, or I'm more than happy to be educated on this. Maybe my understanding is wrong. Could be. Okay. In my humble view, if director's remuneration has already been reduced, we have to add it back. That's how it should. Now, bonus or commission paid or payable to any member of the company staff or to any engineer, technician, or person employed or engaged with the company, whether on a whole-time or part-time basis. So, bonus or commission also should be reduced. That's okay. This is, I have given it 2 times. In the Act, it appears only once. Any tax notified by the central government. Sorry, maybe I'll even remove this. So, yeah. Any tax notified by the central government as being in the nature of a tax on excess or abnormal profits. Okay, so that's D. In India, we don't have any tax on excess or abnormal profits. Normal tax not to be reduced means corporate tax, income tax not to be reduced. If it has already been reduced, you have to add it back. But if there is any excess or abnormal profits tax, that should be reduced. Got it? Interest on debentures, charge on profit can be. Interest on mortgages and on loans and advances secured or charged on its fixed or floating assets. So interest on secured loans, okay? Interest on unsecured loans. Expenses on repairs, whether movable, immovable. Provided the repairs are not of a capital nature. I think this is the very important point that you need to highlight here. Any capital item should not be considered. If it is capital, then no. Means if it is a repair having a long-term benefit, creates some sort of a enduring benefit and it is capitalized in the books into the asset, then it should not be considered. Outgoings inclusive of contributions made under section 181. Okay, we'll be seeing that. That is contribution to any charitable fund, bona fide charitable fund. All that can be reduced. Inclusive of contributions made under section 181. 181 talks about contribution to bona fide and charitable funds. We'll be seeing that when we come to meetings and powers of meetings of board and powers of directors. Meetings and powers of directors. Depreciation to the extent specified in section 123, right? So we have to compute it as per schedule 2, and that depreciation needs to be reduced. Suppose some other depreciation has been charged in the P&L, it has to be added back, and the Companies Act depreciation had to be reduced. Excess of expenditure or income which had arisen in computing net profits in accordance with this section in any year, which begins at or after the commencement of this act, insofar as such excess has not been detected in any subsequent year preceding the year in respect of which the profits are to be ascertained. Means, in an earlier year, you did this calculation and you got loss. That loss should now be set off against this profit. Got it? So, in that year, what you would have done, you would have gone under effective capital, you would have gone schedule 5, etc., etc. But that loss should be now set off for arriving at current year's profit. What they are saying. Any compensation or damages to be paid in virtue of any legal liability, including liability arising from a breach of contract. Any sum paid by way of insurance against the risk of meeting any liability, etc., as above. Depreciation to the extent specified in section 123, appearing twice. Now, in making computations, the following shall not be deducted. Income tax, not to be deducted. Super tax, in India, we don't have super tax. Okay, it's not to be done. Any compensation, damages, or payments made voluntarily, not by virtue of any legal liability under M. Got it? Good. Loss of capital nature, including loss on the sale of an undertaking or etc., etc. But any loss, any excess of written down value, okay, of any asset which is sold discarded over its sale proceeds. See, reverse. Earlier we saw profit up to original cost. Now we have to see written down value and journey downwards. Okay. Any loss up to the written down value, okay, should be allowed. Should be reduced. Anything below that will have to be taken. Okay. So any excess of written down value of any asset over its sale proceeds, which could be lower than it, or its scrap value, that should be considered. Suppose the scrap value or sale value is less than the WDV, then that difference should not be reduced, but up to WDV. So this is a reverse journey. Let us say, after depreciation, I'm carrying it in the books at 60 crore. Due to some reason that has been set up, we cannot sell it at all. Okay. Now, I'm selling it. Okay. Now, when I'm selling it below the written down value, where see, for example, I'm selling it at say 20 crores. Then below the difference between the written down value and its scrap should be taken as, should be considered, should be reduced. That's the point. Okay. Any change in carrying amount of an asset or of a liability recognized in equity reserves, including surplus in P&L account on measurement of the asset or the liability at fair value. Okay. Now, this is what I said there. We saw that now the same question will come here. Okay. Why don't you try it? See if you can get it. I don't know if in India we have anything called windfall tax. See, this type of windfall tax question mark, Aniket, I don't know how to react. What do you want me to ask? Is there a question there? Yeah, if you are trying to say that, I am not able to understand your question. Aniket ji, you have to be a little more fluent in writing. So what do you mean by windfall tax? In India, there is no windfall tax. Of course, we have capital gain tax. Any other income, if it is not part of business income, has to be taxed under income from other sources. So windfall will be taxable as income from other sources. So I am seriously not able to understand your question. Kindly elucidate by giving more information about the question. Can you? And in the meantime, attempt this. So the net profit is arrived at after debiting to P&L account the following items. And similarly, after crediting, the following items are credited to P&L. Okay. See, in India, we have only two taxes, Aniket. Only one tax, income tax. Okay, no other tax. There is no windfall tax now. I would love that you should elaborate it a little more. No, I'm not aware of that, sir. Recently, windfall tax apply on abnormal profit. Can you quote the section number? Which section, which act? Can you give me any? See, just now I told you, I'm not here to believe. I'm here to ask. So I'm not aware. Can you give me a section number? Is it in the Income Tax Act or is it in the, which act is this? Recently, windfall tax apply on abnormal profit. What is abnormal profit? See, if capital gain is covered, any other gain if you're getting, seriously, what do you, by giving further explanation, you only confused me further. Which act is this? Can you tell me which section of which act? Yeah, but if such an act is there, okay, that should be reduced because only income tax, and in India we don't have super tax. See, once upon a time there was something called super tax. Now we don't have super tax. Any income tax or super tax should not be reduced. Please remember. But if, nay boss, I'm not aware of the news. You tell me which one, which section. Aniket, I'm not very comfortable with the way you are giving me this information. I'm expecting more accuracy from a potential chartered accountant. News is not source of information for a potential chartered accountant. Okay, you should be able to tell me, sir, this act has been introduced, this section or something like that. So, no problem. I can understand that you are still a student, so your ability to express yourself may not be that much. I will check up, but to answer your question, windfall tax, that's what I'm saying. Unless I know, if it is part of income tax, it should be excluded. That's why I'm unable to answer because I'm not aware. Seriously, I'm pleading ignorance, Aniket. If you think that I'm an ignorant person, please take it as I'm ignorant and educate me now. What do you say? Educate me on this. No, not okay, sir. I need section number and act. Abhito, no. See, this is the level at which you will be questioned in the real world. You can simply throw something and run away, Aniket. You can simply say, sir, it is in the news, like that. You cannot say. You are going to become a chartered accountant. Okay, hopefully. So your ability to give facts accurately with section number, etc., should be there. But you may be right because there might be something in the news. Sometimes these Times of India and all are there. They will put, there is a possibility like that. That cannot become act. For something to become an act of parliament, it should be passed in two houses of parliament. get the assent of president, be notified in the official gazette, okay? And that notification date should be there. And that date, it will become law. Only then I am bound to follow it as a citizen. So this cycle you should know on which date it was passed in parliament, which date it has been notified in the gazette, date of effective date. Complete cycle is there. I'm not telling this to her, sort of to make you feel uncomfortable, but to help you understand how important it is to be accurate while dealing with things. You are no longer going to be a layman. The word, it is in the news, can be put by a layperson, not by a member of our institute. Member of an institute should quote section and law and say, sir, this new law section so-and-so of this new law has come, sir. If so, I will learn it. I will immediately go learn the law and come. But kindly give me details. Having said that, I am unable to answer windfall tax because, see, what is being excluded is only income tax and super tax. So, recently windfall tax apply on abnormal profits, so that need to be excluded. No, I'm not aware. Because if such a windfall tax is not coming under income tax, then it cannot be excluded. It should be reduced. It should be reduced for arriving at managerial remuneration. Or 198 should be amended and that windfall tax should be included here. Only then it will be exempted. So to answer question on this topic, I have given the answer. But the fact still remains that, okay, sir, is not convincing to me. From Mr. Aniket Jain, I expect more. Okay? Better response than this. Okay, Ji? Go on. Give me the answer for this. Aniket, are you talking about windfall tax on UK? In UK? Yeah, there is a windfall tax being proposed in the United Kingdom. Okay? See, where on the excess profit that oil companies and gas companies have made. Maybe in India, there is no proposal, but there seems to be a proposal in UK. Is that what you're talking about? That is in the news. Yes, you are right. Okay. So I'm not able to see anything relating to India. So let's not go there. Okay, that's UK. In India, suppose a windfall tax is introduced by this crazy government, by our finance minister with all her wisdom, then I would humbly submit that it should be reduced for arriving at managerial remuneration. And I have to be sure if it is brought in as a new law, Windfall Tax Act 2023, whatever 22, then that is not covered under 198 specifically. Therefore, it has to be reduced for the purpose of arriving at managerial remuneration. So I've given you an answer to your question also. And also to confirm that there is no windfall tax in India as of now. Don't give the Indian government any ideas. Again, when you're reading news like this, no, be clear. Okay, applicability of the law to your country and etc. etc. Okay, good. So I think both of us are. See, the beauty is Buddhas like me also have access to the net. But we don't rely on the net as our primary source of information. You understand? What you could see in the net, I could also go and see in the net and come. But that's quick. But I will do more research. Got the difference, Aniketji? From now on, you should remember, I'm going to become a chartered accountant. I should not behave like some common Aam Aadmi. My source of information should not be the internet. My source of information should be Barak, should be original publications, should be good newspapers like Business Line, not Times of India. So check out. So this advice is not given to Aniket alone. This is given to all those people out there listening to me and everybody who is going to download this and listen to me. Please, okay? Once you become a chartered accountant, remember the world is going to really believe what you're saying. If you say something incorrect once or twice and then get caught, your credibility is lost. Once your credibility as a professional is lost, everything is lost. Therefore, you have to be very, very careful while giving our views and our opinions. Okay, and should not rely on internet or basic internet, the Google search as our source of information. Even in Google search, I search Google a lot, no problem. But Google search, don't see the first 5 hits. Go below, go below. Suddenly you'll find you come to the reality. That would be the real fact of that case. Even in Google search, there's a way of doing it. Okay. If you only go through the main shots, you will get only what Google wants you to see or what Facebook wants you to see. You will go deeper, you will get the real facts of the case in all matters. Okay, I'm yet to get any good. This gave us a very good opportunity to explore what it means to read Google and rely. So no problem. See, only IAS aspirants, UPSC aspirants have to be reading the news continuously and updating themselves and all. Chartered accountant students, aram se, once it becomes a law, then only we are going to even come. Which is one of the reasons why many times when the budget is being announced in Parliament, people ask me, sir, have you seen the budget? Have you seen the budget? I'll tell them, I'm not seeing the budget. I don't want to see the budget. Let it go to Parliament. Let it be passed. Let it become an act. I will become an authority on it. Don't worry about it. When it becomes an act of Parliament, I will become an authority on it. Don't worry about it. At the budget level, seriously, I'm not worried about it, is what I would say. Unless you are a corporate executive. And there you will need, because some of these amendments may have immediate impact on your current year's profitability. Sometimes, rarely they might have. Okay. For example, if windfall tax is bought into Indian oil and gas, which I doubt, because India oil and gas, who are the guys, they are players. I'm sure they are not going to be taxed. Don't worry about it. But if you are going to tax them, these guys are to be worried, because that year their profit will go down to the extent of the windfall tax. Okay. Anyway, good question. And I'm still yet to, I'm waiting for you guys to put in an answer there. Give me an answer. None of you is bothering to put an answer. Go on. Put an answer there. Okay, since no answer is coming out, let me give you the answer. So, simple. Ex gratia payment to employee is voluntary. We said voluntary item should not be considered. Add back. Income tax, we already said that, take it back. Capital profit, which is included, credited, should be reduced. Profit on forfeiture of shares, we already saw, should be reduced. So profit as per 198. On that, 5% gives me 91,935. Right? Now here's one more. Can I hope that you will give the answer for this at least? Please note the very important word, before considering the following. Just go through what they're saying. Whole of the R&D expenses has been incurred for purchase of equipment. Capital. On plant depreciation provided up to date was 42,000. There is a sale of plant. Gross profit 4038, salaries and bonus reduced, repairs to buildings allowed. R&D expenses, since it's capital item, not allowed. Directors' fees to be taken, there is sitting fees to be taken. Managing director salary, I'm not considering it. Okay. On the logic I mentioned. Interest on debenture to be considered. Profit on sale of plant not to be considered. Okay. But to the extent of accumulated depreciation, we already saw that now. To the extent of accumulated depreciation on that plant can be considered. Should be reduced. Right? So should be rather added back. The profit 120, no. But to the extent of depreciation, difference between the original cost and WDV should be taken. Right? Anything over and above that, not to be taken. Subsidy from central government to be taken. Since nothing is mentioned about capital, etc., we'll assume it's revenue and take it. So we have 4003 and 200-150, right? So this is how it is. Now, where a company is required to restate its financial statements due to fraud or non-compliance with any requirement under this act and the rules made thereunder, then you have to recover managerial remuneration. From whom will you recover? Any past or present managing director or whole-time director or manager or chief executive officer by whatever name called, who during the period for which the financial statements are required to be restated was a managerial person. Okay. So any past or present MD or WTD or manager or CEO, whatever name called, he was the MD, etc., for which the period for which the financial statements are required to be restated. So past people also, you can catch them. The amount of remuneration, including stock option, in excess of what would have been payable to him as per restatement of financial statements. See what they are. See here again, you can see a paranoid behavior of the MCA. What happened is the MD, in order to increase his remuneration, obviously has done some window dressing and false statement. In this case, definitely the auditor will also be guilty because he would have certified it wrongly. Therefore, there is a restatement. When you studied accounts, you remember a company can restate its financial statements, recompute, do you remember, and reapprove it, okay, etc. But when that happens, this provision says, see, his remuneration was paid based on the old profit, which was wrong, excess. Now, when I compute it, recompute it, it may be loss or it may be lower. So the difference between the two, the remuneration which he will be entitled to per this calculation, and the amount actually paid to him will be the difference. That is, any remuneration in excess of what would have been payable to him as per restatement will be there. Such recovery shall be without prejudice to any liability incurred under the provisions of this act or any other law. See, remember, in these cases, 100% there will be a fraud, the managerial fraud, almost similar to your Satyam and all that. Some managerial fraud is there. Then the auditors will be taken, the MD himself will be under the, the serious fraud investigation office, all that. There are a lot of penalties. So many penalties are there, okay? In 44 and all is there. In addition to that, he will also have to refund the excess remuneration. See, this is something they would have learned from Satyam. Because, see, remember, Mr. Ramalinga Raju restated his profits to his advantage. But that was not done with a view to getting more remuneration. But one of the consequences would have been that, obviously, that excess remuneration you would not have taken. Because he knows very well that profit is not correct. So he would have taken within the limit, or even there could have been a slight excess. Okay, but in which case, that excess could not be recovered because the old law did not have similar provision. So then they realized its weakness and loophole. See, because of Mr. Ramalinga Raju, the Companies Act has been made so tedious. The MCA, that one Satyam learning, the MCA has applied and they have made the law unnecessarily tough in some areas. Anyway, this is not a wrong provision. It is good. We can as well see it. Now, notwithstanding anything contained in this chapter, a company may, while according its approval to any appointment or to any remuneration under in respect of cases where the company has inadequate or no profits, fix the remunerations within the limits specified in the Act at such amount or percentage of profits of the company as it may deem fit, keeping in mind. So the idea is the shareholders are given an opportunity to put a ceiling on the remuneration. So you cannot ask the shareholders to give you blanket approval. So while doing that, they will have consideration for financial position, remuneration drawn by him in any other capacity from any other company, his professional qualification, etc. Okay. Every application made to the central government under section 196 shall be in form number MR2 and shall be preferred within 90 days from the date of such appointment. Okay. Before any application is made, that's why I'm saying, well before April, May, March, you will know that there will be a problem in the next year. So my suggestion, make an application, you appoint him and make an application. Means you appoint him in February itself. You remember, he can be reappointed before the end of the 5th year. From the beginning of the 4th year onwards, you can reappoint him. Reappoint him and immediately apply to the central government and keep it ready. Before any application is made by a company to the CG under section 196, there shall be issued by or on behalf of the company a general notice to the members indicating the nature of the application proposed to be made. Right? Such notice shall be published at least once in a newspaper in the principal language of the district in which the registered office of the company is situated. The idea is any public who has some information who want to oppose this can make a direct representation to the central government. Means because now the matter has gone into public interest area. See, you are going to the central government for approval. So now any public can go there and say, hey, don't give this approval because of these reasons. The central government can ignore it while giving approval, but this opportunity is given so that everybody knows about it, going beyond shareholders. Matter is no longer with the shareholders. It has gone into the domain of public interest. So, because central government is going to give its approval, a government servant is going to, and remember, the government servants are our servants, and the parliament is us, president. We appointed the president through the parliament, and that president is appointing these gentlemen. So they are our servants, and as such, they have to keep in mind public interest mainly while granting approvals. The copies of the notice, together with the certificate by the company as to the due publication thereof, shall be attached to the application, right? A company may make payment to a managing or whole-time director or manager, but not to any other director by way of compensation for loss of office or as consideration for retirement from office or in connection with such loss or retirement. So, company can make a compensation for loss of office. But it cannot make to any other director. So, compensation for loss of office can be paid only to MD, WTD or manager, but not to any other director, right? So, no compensation is payable to directors other than MD or WTD. Of course, MD, M or WTD. Prohibition on payment of compensation. So, first of all, they say you can pay compensation to MD, M, WTD. Enjoy. But in certain circumstances, you cannot pay compensation. Be very careful because in the examination, they might give you a question where they bring him under one of these conditions. So, where the director resigns from his office as a result of the reconstruction of the company or of its amalgamation with any other body corporate or bodies corporate and is appointed as the MD of that amalgamated or resulting body corporate. So, where is the loss of office? He is resigning here and he is reappointed there. Where the director resigns from his office otherwise than on reconstruction of the company or its amalgamation. So, first is he is resigning specifically on reconstruction and he is being appointed in the reconstructed company. There is no loss of office, so no compensation. Where the director resigns, he is doing it unilaterally. We are not asking him to go. It was his decision to go. Therefore, when he resigns, whether on reconstruction or not, or otherwise than on reconstruction, then no compensation. Where the office of the director is vacated, this is a nice point because, see, all the points of vacation are defaults or failures. So a man who has defaulted or failed and therefore has vacated cannot claim compensation. Agreed. Where the company is being wound up, whether by an order of the tribunal or voluntarily, and that winding up was due to the negligence or default of the director. So because of his negligence only, winding up has happened. Sorry, he cannot be paid compensation. Where the director has been guilty of fraud or breach of trust in relation to, or of gross negligence in, or gross mismanagement of the conduct of the affairs of the company or any subsidiary company or holding company. Okay. Where the director has instigated or has taken part directly or indirectly in bringing about the termination of his office. So in these two cases, there also he can be. First is where he is guilty of fraud, breach of trust, etc. So usually what will happen in those cases, some criminal action will be brought against him or civil action will be brought against him for recovery of them. In those cases, no need for paying compensation. See, this F is where he has not done anything blatantly criminal, but he has done something which was against the interest of the company. We came to know about it. We have found it. Maybe a forensic audit was conducted. The forensic audit resulted in no criminal findings, but it came out with enough evidence to show that this guy has acted against the interest of the company. So we asked him, what are you going to do? He says, you do whatever you want, then we remove him. For this reason, then he cannot be paid compensation. Okay. Actually, in those days, there used to be one more clause, which is not here. Because the reason is this. In the current law, appointment of a managing director does not need the approval of shareholders. Please understand, appointment does not need approval of shareholders. Board can appoint. Payment of remuneration in excess of the limits, only that needs approval of shareholders. That is why the earlier appointment itself had to be approved by the shareholders. There they said, if the shareholders do not approve, then you cannot be paid compensation. Here, appointment does not require any approval. Therefore, they are saying. Today, see, if a company is making good profits, then board of directors can appoint the MD. Then if the company has made good profit, they can pay the remuneration. No need to go to shareholders at all. Except disclosure in the balance sheet, annual report, blah, blah, that's nothing else. You can keep on going. It's only when you make losses or inadequate profit that you are in trouble. Schedule 5, clauses, special resolution. Or if you want to be more than the limit, sublimits, or more than 11%, then you have to, because more than 11% is going to go to central government straight away. So quantum of compensation, meaning amount. Quantum means amount. Quantum of compensation is the remuneration which he would have earned if he had been in office for the remainder of his term or for 3 years, whichever is shorter. Calculated on the basis of the average remuneration actually earned by him during a period of 3 years immediately preceding the date on which he ceased to hold office, or will he hold the office for lesser than 3 years during such period. So here is a simple numerical way of understanding. There are only 5 years. He will, at the end of 5 years, he'll automatically get out and you may not reappoint him. Suppose he is being removed at the end of first year, then he will get the first year's remuneration into 3. Suppose at the end of second year, then remuneration of 1 and 2 divided by 2 into 3. At the end of third year, he has only 2 more years to go. Am I correct? So he'll get only for 3 years. Okay, proceed on which calculated on the, see, the remuneration which he would have earned if he had been in office for the remainder of his term. Here, the remainder of his term is only 2 years. So he will get only for 2 years. On the basis of average remuneration earned during the first immediately preceding 3 years. Now, fourth year, only 1 more year to go. That year, he will be paid average remuneration of the immediately preceding 3 years. So that will be only 1 year. Suppose he is removed at the end of the 5th year, was no compensation. Okay. This is number of years of completed service. And Rn is the remuneration actually earned during year N. Right. No compensation is payable if winding up commences within 12 months of ceasing to hold office and assets are insufficient to make the payment. Nothing in this section shall be deemed to prohibit the payment to an MD or manager for any remuneration for services rendered by him to the company in any other capacity. Okay, so you can pay him that amount. Now we move on to KMP, key managerial personnel. Okay, these are the key KMPs. We saw that CEO, company secretary, WTD, CEO or MD or all three together, CFO, such other officer, not more than one level below the directors, who is in whole-time employment. For example, VPs, the vice presidents, may be not part of board, but the board may designate them as KMPs. Okay, such other officer as may be prescribed. So every listed company and every other public company having a paid up share capital of 10 crore rupees or more shall have the following whole-time key managerial personnel, where they are having more than paid up share capital of 10 crore or more. Okay. So you remember I told you to prepare a chart long ago. I don't know how many of you remember that. Include this. So compulsory KMP, share capital, paid up share capital 10 crore or more. That such a company should have MD and or WTD, or in the absence WTD, company secretary and CFO. Okay, company appointment of company secretary compulsory. Every private company which has a paid up share capital of 10 crore rupees or more shall have a whole-time company secretary. Okay, 10 crore rupees or more. That is again, in addition to the above, they should have a whole-time company secretary. Okay. Now this is something about chairperson. Okay. See, the articles of the company provide, the person shall not be appointed or reappointed as chairperson of the company as well as MD. See, in those days, you had this fancy title called CMD, that is chairman and managing director. Now, under 203, that is not allowed. You can have both chairperson and MD, unless the articles provide otherwise, or the company does not carry on multiple business. Okay. See, I tell you, these are all, the company cannot have chairperson and MD. But they can have chairperson and MD if the articles provide, or the company does not carry on multiple businesses. Okay. A company having a paid up capital of 100 crores or more and annual turnover of 1,000 or more, engaged in multiple businesses, which has appointed one or more CEOs, may appoint an individual as MD as well as CEO. Simple example, ITC. ITC is paid up capital 100 more, annual turnover more than 1,000 crore. Check out. They have multiple businesses. Each business has an MD, CEO. Each business has CEO. Okay, each business has its own CEO. And that company as a whole can have a person who will be an MD as well as CEO. Okay, an MD as well as CEO. Okay. So they'll have both MD and also multiple businesses will have CEO. The KMP shall be appointed by resolution of the board, etc. The whole-time KMP shall not hold office in more than one company, except in its subsidiary company at the same time. Okay. So a KMP can be a director of any company with the permission of the board. They cannot be whole-time director, but they can be director. Okay. So they cannot hold in more than one company. So any KMP holding office in more than one company should resign within 6 months. Okay. A person may employ a person as its MD if he is MD or manager of one and not more than one other company. And such appointment or employment is made or approved by resolution passed at a meeting of the board with the consent of all the directors present at the meeting, and of which meeting and of the resolution to be moved thereat, specific notice has been given to all the directors then in India. I know this is coming at the fag end of the class. Kindly, if you have gone to sleep, wake up. You more than one MD of more than one company possible, but he can be in only one and not more than one other company. Okay, and such appointment should be made by unanimous resolution. And notice calling the board meeting should give specific notice that the appointment is going to happen, so that even one independent director can say no. Then automatically there's a conflict of interest. No, And remember, the word used here is other company, not other public company. So even he cannot be MD in more than one other company, including a private company. So, got it? If the office of any whole time, in those days, private companies were exempted. But now they are saying one company, one more, that's all, private, public. If any casual vacancy is there, it will be filled up by the board within a period of 6 months from the date of such vacancy. If there is any contravention, there is a penalty, 5 lakhs and for the company, and every office director and KMP who is in default, 50,000 rupees. Continuing offense, 1,000 rupees beyond the. They have also provided for secretarial audit. Okay, in these cases, paid up capital of 50 crore or more, or turnover of 250 crore or more, or every company having an outstanding loan or borrowing from banks of 100 crore or more. Secretarial audit should be conducted in the same way, and any qualification should be explained by the board. Okay. That this is regarding the duties of the whole-time practicing company secretary and the company secretary of the company. Okay. They have also defined a rule for functions of the company secretary. Finally, we have come to the end of the session. I thank you for the wonderful support and listening. Thanks to this, we could complete this topic within one session. Since no questions have been raised by you, I shall presume that thing. Aniket, thank you for putting amazing session and all. Possibly, according to me, this was not a very, very interesting section. But don't worry, when we take up meetings and board of powers of the board, subject will become more interesting again. One more humble request to all my students out there, Darasha, Aniket, Jain, Vanacharla doesn't come nowadays, K. Gayatri, etc. All of you, please download the assignments for both the sessions and keep it worked out. Maybe in one of the sessions coming forward, I will solve it and we can close it. Okay. Thank you. Wonderful. Thank you, Mr. Aniket ji. And sorry for that windfall thing. Don't keep it in mind. Okay. Bye. Class over, sir.